So today we are going to learn how to understand company performance. I think that's what plays a role in NSE trading, alongside demand and supply. So we learn how to interpret numbers. A bit of introduction. I don't want to go into detailed explanation so that you don't get lost. On Wednesday, now we'll do a detailed one. Then a bit of dividends, and very important, there is a spoofing. I think most of you may have fallen victim of it. It's only that in the market we usually don't talk about these things because of the regulations. But it's also good you know what happens the spoofing. Not somebody placing an order just to spice the market, but that order will not execute. So they move the price based on what they want. I think it NSE, they may have tried to capture it because I've seen several emails this year asking why most of the clients cancel. But if you look at the quantity they are trying to target, that's not somebody with spoofing. 100 shares, that's not spoofing. But from 1 million, you can tell there's somebody playing with the market because those are orders you don't actually see in the order book or market depth. If you see such orders, then as we come to that discussion, you may realize there are people who play with the market. They just play with their psychology, make sure you can see there is either demand or supply, and you get in and price will move their way, and they take advantage of that market. Then I also want to clarify on upside good, because I think most of you are excited, but you don't know what you're getting into. You may think you'll make money through upside good, but ideally you may be losing, because you may buy, then the prices go down. You know that stock is not that volatile, and the spread, that is the difference between ask and bids, is usually wider. That tells you it's not a stock you can easily sell without making loss. So once we understand that, I think now from next week, we should be able now to trade comfortably, especially now we are going to Q3 results. Most of the banks will be announcing between end of this month and early November. So you need to understand how to do it. Again, for those who have just joined, I'm Peter Chega, Head of Product Development and Innovations at AIB Axis. Let me see if there is any question before we start. You should. It's done. Rugambi, can you confirm you can hear me? I think I'm already close to the mic. Just confirm you can hear. I think there is a question there, and as we come to the presentation, you'll actually realize it is done either way. There is a way you can do it, but I don't want to show you. There's a way you can do it on the platform. Still, the rest, can you confirm you can hear me clearly? I think, Rogabi, maybe you can increase your volume on your side. Maybe it is volume on your side. The rest, you can hear me? And the volume is okay? Maybe Rugambi and Patrick, maybe you can increase your volume. You can increase your volume on your side. Okay, volume is still low. Because I'm close to my mic, I think we can start. For spoofing is done either way, but most of it is by traders. By traders, I mean broker employees, because their system is not connected to CDSC, and also broker platform to confirm whether they have funds or they have shares. So them, they're able to do it. But you also as a trader, if you have shares or cash, you can be able to play with the market, but it is market malpractice. You don't want to get into CMA issues because you may end up being penalized. So I think let's start. I will start first with financial reports that are specific to the market. That is the financial results that are usually declared by the company. So when a company releases their financial results, they are simply showing you how the business is performing. Remember, when you buy shares, I think for those who came earlier, we said when you buy shares, you're becoming a shareholder. You're exchanging your money with a portion of that company or a portion of ownership. So you become a shareholder. You're entitled to know how the company is performing. So these companies, they are mandated by the regulator and NSE to make sure they disclose their financial results to their shareholders. It will show you whether they are making profits or whether they are losing money and whether they are growing. Because you want to be in a company that is making profit. Most of them, they share that in form of dividend. You also want to be in a company that is growing. If a company is growing, it means also its value at NSE is also growing, meaning price will also appreciate, which means capital appreciation. You don't want to be in a company that is losing money. If it loses money consistently, it's making losses, then chances of closing are very high. Chances of being suspended by CMA are also high. So there are various types of reports that are released. One of them is quarterly result. Mostly these you see with most of the banks and also Safaricom. They release their quarterly results every 3 months. Like now, as I have said, around October, November, most of the banks will announce. And also Safaricom will be announcing their Q3 results. So banks and Safaricom. It's something you need to watch to see whether, based on the results they announced, I think half-year results, have they improved their performance or is the profit going down? Because that can tell you what will happen with the prices. Remember, for us investors, we go by market sentiment. If a company makes losses, people still talk about it, and we all panic. We want to sell. If it makes profit, we all want to be part of that, because if in the first quarter they have announced a profit, you expect maybe in the next quarter they make also another profit, meaning they might give an interim for those who give interim dividend. Or if they give final dividend, then if you track the first quarter, second quarter, third quarter, you realize they're making profit, then you assume even on quarter 4 they also make profit, then you expect them to give first and final dividend for those who give just one. So, as I've said, Safaricom and banks will be releasing their Q3 results. That's something you need to watch. And between now and the time they release, there will be a lot of anticipation. You might find prices fluctuating up and down. Don't be scared when price goes down, then you want to sell. When they go up, you want to buy. Watch the market. Enter when prices have gone down. If you want to take profit when prices have gone up. Most of us, we wait until prices start going down. That's when you want to take profit. Don't in the NSE, never rush to take your profit. As we have seen in the previous trainings, I always train on wealth building, not capital gains. In NSE, if you want to lose money, chase capital gains. Why? When these companies announce their results, they may announce a loss this quarter, and you quickly rush in to sell. But maybe that loss, it's something maybe they were paying. A good example, Stan Charter. They have this case they have with their employees who retired, their pension. It will be provisioned maybe in this Q3. Maybe it was even provisioned in Q3, and you want to sell because you have seen there is a loss that is booked in their financials. Yet it's just for that quarter. Then next quarter, they report a profit. You sold when you panicked because of that loss. Then when they make profit, prices go up, you want to buy. Remember, you have, first of all, you have lost when you sold, and you want to buy when prices are going up. So you are losing two ways, through the sale and when you're buying at high prices. So it's always good you watch those results, even if not in details. Just understand the basics. Have they made profit? Have they grown in terms of their sales? Are they intending to do innovations? Because that's the time they declare what they are doing. Then there is a half-year results. It gives a clear picture of what the company have done mid-year. And most of the companies, they use this maybe to give an interim. Interim dividend is the one that is given when half-year results are declared. But not all companies give. It's only those that their directors have approved. Then there is a final result. That is a full year result. This is detailed and audited. Half year is not audited. It is an audited result. Quarterly reports, they are not audited. So only the final year, that is annual results. Those ones, they are fully audited. So at that point, you find the companies, they are giving either the final dividend, if they give an interim, or first and final. First and final means it's the only dividend they are giving for that year. They are not giving another one. Now, using quarterly results, you may find there are companies that give special dividend, like Safaricom. They may announce maybe in Q3, they made extraordinary profit. They may decide to give a special dividend. So special dividend comes with the quarterly results. Half-year results is interim for those who give. Full year results, it's either first and final or the final dividend, or there are those who give final and special, like what we saw with KCB. So these reports will help you as an investor to see, one, how strong that company is. Does it have growth potential? How stable is that company? Does it have issues within their own operations? And how risky that company is? You don't want to be in a company that is reporting growth and there is no growth. Even if there is a debt, it needs to be supported by some kind of growth or innovation. So you want to know all this before buying shares. So before you buy shares, always understand financial reports. And you don't need to go into details. That's why I said today is basic. We are not analysts. Analysts do their work. They give us the summary. Our work is you just look at just the overview. By just looking at the financial statement, you can easily make a decision whether this company is making profits through their P&L, whether they have their net asset value is increasing. That is a difference between total assets and liabilities. And also, it will tell you whether this company has a lot of debt. And very important, cash flow. So the first report you find in the financial reports is profit and loss statement. That is income statement. I will show you once I go through this with KPLC. I like using KPLC as an example because they've already declared a dividend. And they announced their result, I think, was it this month or last month? So P&L, that is profit and loss statement, will show you how much money came in terms of revenue and how much they used for expenses. Then the difference is the profit before tax. Then there is a tax that will be deducted. Then there is profit after tax. So you as just a layman investor, you only need to be interested with profit after tax, unless you want to go into details now to know revenue, where did it come from? They give breakdown. Expenses, what did they pay? They give breakdown. How much tax did they pay? Because again, you don't want to be in a company that always riddled with a lot of tax, because that eats into your profit. And that would tell how much government influence in that company. So if revenue are growing than expenses, then it means profit are rising. So you need to compare previous year and current year. Most of them, because that is the reporting standards, they usually give current year and what they did previous year, so that you tell whether profits are going down or up. And for those who do analysis, I think next Wednesday, I come with a template that can help you book those revenues. You should have an Excel that you're able to track maybe from, let's say, for the last 10 years. For the companies you are interested, you don't track everything. You only track what you're interested in. Their profit after tax, how has it been performing? Because that tells you the growth potential. And it will tell you whether the profit this company is booking, whether it's genuine. A good example, Kenyapa used to be at a loss, but all of a sudden, profits have started trickling in. You can tell that with their expenses and also their revenue. Is the current profit position justified? Were their losses justified? Because that's the way you can interpret those statements. And you know whether you want to get into risk if the profit is not justified, it's just there for reporting purposes. Were the losses justified or was it politics? Do you still want to get in? So a good example, let's assume KPLC, in terms of revenue, they have made 20 billion. Then they have spent 18 billion. The difference between the two is what is profit. But remember, this is profit before tax. Now, when you go into their financial results, they show you even the tax they have paid and how much they have retained as their profit. Because that profit after tax is what they share with you as dividend. The other report, very important, is a balance sheet. It shows what the company owns, that is their assets, and how much they owe in terms of their ability. So assets is what they own. That's like buildings, if they have vehicles, machinery, like that. Liabilities, what do they owe? They are debtors. In this case, they are usually called creditors. The people who have supplied them, but they have not paid, and other debts they have not paid. So it's like you're checking the net worth of that company. As I said, net asset value of a company is determined by assets, total assets minus total liability. It gives you how much the net worth of that company. So an example, if let's say equity owns 1 trillion, and it owes around 900 billion. You see it on the balance sheet. I'll show you with KPLC. The difference between the two is what is called the net worth. It's the equity. Then there is a cash flow statement. It will show you how money moves in and out from either their own operations, investments, and financing. If you want detailed now breakdown of these items they are financing, where they're investing, and operations, then you would need a detailed financial statement. It is usually shared with their prospectors. You can find it on their website. The one that you see on the news or even from the brokers is just for reporting purposes. It is usually the detailed one. So if a company is not managing their cash flow, then you'd expect that company to fail. And most of the companies in NSE, these are they fail. It's not actually on the debts and also the profits they are making. It's the usage of their cash. But again, as we will see, not everything you see on the paper is usually correct. Most of these companies, they just do it on the paper for reporting. But if you go into detailed analysis, you may find maybe a company is even making a loss, but it is reporting profit just for the paper, just for the market. Remember, they are doing this reporting for the market, not for the regulator. We'll come to that slide. So before we go to key terms that you need to know, which are usually shared with by our research team, let's go to financial statement for KPLC. Let me just share. Where is it? It's here. So this is for KPLC for the year, year. So this is the final audited results. As you can see, it is audited financial results for the year ended 30th June 2025. So on the left side, where there is a table, this is where you have the three statements that we have seen. On the right side is now the commentary. Commentary for the numbers you can see on the left side. So if you're not a finance person or you don't know how to interpret the financial statement, don't struggle with it. Just go on the performance overview or whatever they usually give it a title, maybe a commentary. Just read through. It summarizes what is on the left. So the first one, it is the profit and loss. As we have said, we have the first part of the revenue all the way to where you can see gross margin. So revenue from contracts with customer, then cost of sale, the difference, gross margin. So those are the revenue. Below that, we have other income and operating costs. So the operating cost is now the expenses. So the difference between the two is what gives you operating profit. There could also be other income, like interest income, which is not related to the operations, and other costs that are not related to internal operations. Finance costs, like what people see are calling. The difference now gives you profit before tax. So this is the profit they are made. Below that, there is a profit after tax. This is the most important. So when you go to P&L, just go straight to profit after tax. Compare for last year and this year and see the performance. Like for Kenya Power, it went down. But again, as you can see, the drop is usage by customers. You can see the revenue from customers have gone down. That may tell you something. Either there are people who have defaulted, because in 2024, the revenue was high. 2025, revenue went down. Either there are people who have defaulted and they have been disconnected in 2025, or they usually account using USD. Most of the companies, they do through USD, then when reporting, they convert it Kenya shillings. So the drop in dollar may have affected their revenue. So that is P&L. We'll come to earnings per share. Don't worry, it's a terminology in the market. And in most of the companies that do reporting, you find they have done it for you. You don't need to do it. We'll come to it. Then we have a statement of financial position. This is the balance sheet. The second one, condensed statement of financial position. This is the balance sheet. It usually have the first part, assets, both current and non-current. So the total assets, you get it at below, before you move to equities and liabilities. So you need to know how much they own. There is property, plant, equipment, and other non-current assets. And there is also current assets. There is the total. You can compare between last year and the reporting period. Like now, it is for 2025. So you're comparing 2024 and 2025 to see if they have increased their assets. And again, you can go even into details and see what they have actually increased and what they have reduced. Then below that, ignore the shareholder equity. There is non-current liability and current liability. That's what you need to add. That is the total liability. So total assets minus total liabilities, that is non-current liabilities and current liability, will give you the net asset value of that company. Like now for KPLC, it is the part for shareholder equity. Because if you are to add total assets, you have around 389,039. Then non-current and current liability, you're adding 162 and 117. If you do the difference, it's actually around 109. So it looks like the net worth value of KPLC have gone up from last year, if you can check the shareholder equity. Last year it was around 87. This year is around 1.9. So that's the only thing you need to know. Is the net value of the company growing? So these are companies that is growing, but again, well, as I said, this is for reporting. It's on paper. In reality, is it what is there? You can always tell from their commentary. I don't want to go into details. I think this was circulated on media. You can just go through it. It can tell you whether whatever is reported is true. Then below it now you have a cash flow statement. It tells you, it actually tells you how they generate their income. So you can tell for KPLC, mostly is through operating activities, most of them being supply of the electricity. And after you net off cash flow out, then you have the net equity position at the bottom. And you can see it has gone down from previous year. Previous year it was around 10 million. This year is around 7.7. So it tells it has gone down. Hopefully, when they are releasing the half year, we don't see a shift now for downward trade. Because then we may go back to where KPLC used to be. So most important, P&L, always be interested in profit after tax. Compare last year, this year. Balance sheet, go straight to shareholder equity because that's the difference between total assets and liabilities. It tells you the net value of the company. So you just go to, most of them, they call it shareholder equities or we can call it equity. You just go and compare that. You don't need to worry about the rest unless you want to see what have made the either increase in value or decrease. That's when now you start going into specific items. Then cash flow, just go to cash and cash equivalents. Compare from last year to this year, have it dropped or increased. If it is dropping, it tells you the net value of that company is also going down. So let's go back. This is just a basic. So I don't want to go into commentary because it may take a while. I want today we go through spoofing in details and also the ETF and how you can create your own watch list. As we said, you want to track shares that you are interested. You can create just a summary watch lists on our Apple portal just to be tracking those shares in form of prices. Because when you are doing valuation, you need prices. So some of key terms that you need to know as an investor, one of them is earning per share. Earning per share, it tells you how much profit each share earned. That is the total profit divided by the total number of shares that have been issued. So if a company, let's say, made 100 million and it has around 10 million shares, you just divide the two. It means every share made 10 shillings. So 10 shilling per share. So that's how much profit each share earned. If we go back to KPLC, let me stop sharing. We go back to KPLC because this is already calculated for you. Go back to KPLC. Like for KPLC this year, if you go to P&L at the bottom, basic and diluted earnings, it is 12.54. It means for every share, they earned a profit of 12 shillings this year. And you can see it has declined from last year. This is already calculated for you. And once I'm done with the terminologies, I'll show you a report from EIB where they have done that for you. They usually do it on daily basis. You know, prices move on daily basis. So how can you use earnings per share? Higher earnings per share means more profitable company. Like if you look at the KPLC, you compare earnings per share last year and this year. Last year it was around 15. It has dropped to around 12. It means its profitability is going down. This is what I said. In the next results they'll be announcing if they announce half-year results. I've not seen KPLC do that. That tells a lot. That's why I said some of these reporting could be on paper. For those who have been in finance, they know. Pressure from top can tell you just fixed figures for reporting. I wish they could report half year, because now you compare earning per share half year and full year. That way you'll be able to tell where the company is going, whether it's becoming more profitable or it's losing its profits. Then there is a price to earning ratio, PE ratio. It will show you how expensive a share is compared to its earnings. So let's say a share in the market costs around 100, and its earning per share, remember this is already calculated for you, earning per share is 10, then you divide the share cost, that is the price, divided by earning per share. Like for KPLC, the price is ranging around 12. If you have to divide with the earning per share for the previous year around 12, it's around 1 shilling. It still tells you this company is undervalued, but that does not mean you buy. Fundamentals matter. I always insist, don't look at the ratios. The ratios are just calculations. And those calculations have been done by somebody else. It doesn't mean they are correct. Always look at the fundamentals. So a high P means investors expect future growth. And note, underline the word expect. It does not mean there will be future growth. A low PE, it means that company is undervalued or there is slow growth. Like most of the stocks in NSE, they are undervalued. And now when I say most of them, it's most of them, 95%, they are undervalued. Then there is a net asset value. It shows you the real value of the company. Assets after debt. Remember, we have seen it previously, where you are deducting total liabilities from assets. That is the net equity. It is the net real value. It is the real value of company assets. So those are most of the key ratios you need to know. As I've said, earning per share, this you find in most of the reporting, it's always calculated for you. So this is already calculated for you when they are reporting. PE ratio, this you have to do it manually, but fortunately our research team, they have done this for you. And I want to show you that report. Net asset value, you don't need to calculate. It is there on the balance sheet. The shareholder equity, or whatever they call equity. If you take the assets out, you take the liability out, whatever is remaining is there, either shareholder equity or equity, depending on the reporting of that company. That is the net asset value of the company. So let's go to, let me see if there is any other. Let's go to that report that is shared. We see these ratios. And again, I don't want to go into details. And if you have any question, remember to put on the chat. So it's called the daily watch list. Daily watch list. It is shared on our WhatsApp channel. If you scroll down, it is this report. If you scroll down, at the bottom, there is this table that was included. It has all the ratios that you need. So very important, what you need to be concerned about is the trading EPS, because that is earning per share. And as you can see, for banks, it's high. If you go to the banking sector, if you go to telecom, where Safaricom is, where is it? So the bottom, its EPS is around what? Let me remove this. It's around 1.59. If you compare that with banks or even insurance, if you go to banks, the banks, it looks like the EPS for the banks is up compared to Safaricom. But don't compare the companies like that. You only compare peers in the same industry. So as you have said, higher EPS, more profitability. Does it then mean Safaricom is not profitable? If I may ask a question, its EPS is around 1.59. That's not true because they put much of their profit into expansion. You have seen they are going to Ethiopia, and they also have other innovations. If you go to banks, most of them it's because of loans, interest on loans. That's why their EPS is high, and some of them they may be supported by international banks like Standard Chartered, and there is also ABSA. I'll be interested in ABSA. ABSA is a bit down. There is also Diamond Trust. Its EPS is also up. So you have everything calculated for you. Then we have PE ratio. It's after dividend per share. Then we have price to book. This I didn't cover today, but I'll cover next time. I just wanted to highlight on the three. Then there is a PE ratio. PE ratio, what we have said, we just go to that. PE ratio will show you whether the company is undervalued or it is overvalued. If you look at it, most of the companies at agriculture, they are undervalued because their PE ratio is negative. They are way undervalued. Hopefully, our team didn't miss to add something, because that looks also suspicious. But if you go to the banks, PE ratios, if you look at them, most of them, they are undervalued. I don't think there's any, apart from HFCK, which I always don't advocate, and also Bank of Kigali. Maybe this is because maybe the information is not fully out. Maybe they are relying on steer. If you notice, housing finance looks overvalued compared to the other banks. The other banks, they are undervalued. Let's go to Safaricom, 17.6. It may be look fairly valued. But for banks, they are usually undervalued. But that's NSE for you. When we come to a few slides ahead, you realize why some of these, as I said, is information on paper for reporting. Don't think here we have any net asset value. Yeah, this is not calculated. But there are also other ratios like return on equity, return on assets, and also price to book ratio, and also dividend yield. They are also important. These ones will come to them on Wednesday, so that now, that time, I will have created now Excel sheet, which now you can play around with it. You can be feeding data on your own. But remember, why you need to feed data daily? It's because of pricing, current price. It keeps on changing daily. And also volumes traded. Those ones, they keep on changing. So let's go back to presentation and sharing that. Can also close this. I don't need it. I also don't need this. Let me share the presentation again. This is just a basic introduction. Next week, on Wednesday, we'll go into details, because today I want to deal practically with ABSA Gold and spoofing, because we are already fallen victim of spoofing, and also ABSA Gold. I think I saw an article on Business Daily that people are moving into ABSA Gold. But interestingly enough, I'm trying to look at those people who bought. Splits were around, or you'd see it's one split. One split is a single order. So where did they get this information from? Because of just viewing the market prices, which will always mislead investors if you're looking at the prices. That's why market depth is very important. We'll come to that. That's what I want to dwell with. Then, after you understand now financials and the ratios, there are many. you need to know how to identify growth or decline in any company. So you need to compare numbers and ratios over time. You can't just compare for 1 week and expect to come up with something concrete that you can tell this company is growing. It's a period, maybe over some years. So like for growth signs, you need to check revenue and profits. That's why I said you need a tracker for revenue and net profit. You can also add expenses so that you see when revenue is growing, are expenses growing or reducing? Because that tells on the profit. It's like you're creating your own summarized P&L with just the revenues, expenses, then the net income after tax. So you track that over a period of time, depending on how frequent that company announces, because you would want to see whether revenue is going up and also profits. Because revenues could be going up, but profits are going down. It means expenses are eating into those profits. You may want to dig deeper to see which expenses then are eating into those revenues. If revenues are going down and profits are going up, then that tells you there is misreporting. You may want to know, why is the profit going down? Up, well, revenue is going down. Maybe even the expenses have been reduced. Does it mean there are some which have been excluded? Then rising earnings per share, that will tell you, as we have seen, to tell you whether the company is growing. Then stability in terms of cash flow. We have seen for KPLC, in 2024, cash flow was up. 2025, it has gone down with around 3 million. If now you have for 2023, 2022, and 2021 and 2020, you can easily tell the pattern. Now we are going to 2026. I wish they would do a half-year results. We see its cash flow. Is it going down still? Because for KPLC, as I always talk about KPLC because it's a counter that will lead many into trouble if you don't invest with fundamentals. Don't invest on data. Don't be told EPS is going up, cash flow is going up. Check whether there is any tangible innovation they are doing. Are they expanding, or are they just relying with power supply? After elections, we don't know what this government that will come in will do. They might decide, let's support solar and make it even cheaper. KPLC will start losing. So you need to check, are they also diversifying out? Then you also look at the healthy dividend payout. For KPLC, they just started last year, so you don't need much to compare. But for the other companies, you can compare. Because dividend payout means how much company is paying from their profits. If it is increasing, it means this company is growing in terms of profits. Also check, are they investing? Because they may be giving out all their profits and they are doing nothing. Like Williamson Tea and Capchoro, they give much of their profit out. Sanchat, they give much of their profit out. You can see, you can even tell with their dividend yield and also their dividend they are giving. So you need to check, are they giving out, even if dividend is increasing, are they giving much of it? What are they doing to spark growth for future? You're not targeting short term, you're targeting long term. Warning signs, that is decline signs. One is the falling profits, or when revenues start to shrink, and you have to track over a period. Also debts. Most of the companies these days, and I think the regulator needs to review the reporting. They need to include their debts so that you know whether those debts make sense. Why am I saying this? If KPLC, they are reporting their debts have reduced, and Kengen are reporting their creditors have increased, then there is a discrepancy. Because KPLC gets power from Kengen. They owe Kengen. If Kengen says their creditors, the people who owe them, is increasing, Then KPLC, they are reporting their debts have gone down. Then there is a problem. Because then who are these creditors in Kengen who they owe this much? Unless it is suppliers. That's why that breakdown in debts needs to be there. So that you know, when you're comparing Kengen and KPLC, because they're in the same sector, and they support each other, then you know, debt on one side is a creditor on the other side. They should at least be equal. Even if not equal, there should be some similarity. Then if there is negative cash flow, that is the amount they are retaining in form of cash is reduced, and then there is a problem somewhere. And also dividends. If you start noticing a company dividend is declining, then there is a problem with their profit. You need to check, is it that they have started investing in other areas, or is it a decline in profit? So for you to decide whether a company is growing or declining, you need to check on this. And always ask yourself more questions. Even if research tells you dividend is increasing, ask yourself, why is it increasing? They will not tell you why it is increasing. It's our work as investors to check, is it that they have reduced on innovations, that's why they are paying? Or is it they just sold maybe an asset, that's why they're increasing their dividend? Or is it that their revenue have increased and their expenses, maybe they have reduced? As I said, the reporting is for paper. That read just to familiarize yourself with the company. Go into the commentary. Now use that commentary to interrogate whatever they have reported. That is, whatever they have said on the notes, does it align with what is on financials? Wednesday, we'll try and do maybe for one bank, Safaricom, and maybe another stock. I wish some of the stocks that personally I know they cook books they would announce, because that way you'll be able now to tell whether these books are correct. Because eventually if you go to their website and you download the full financial results, that book, you'll be able to tell directly whether whatever they reported is true. Remember, they report for investors, and they report because it is a requirement. So let's go now to how you read in between. Remember, now you have the numbers, they have been reported. But then, how do you know whether they are real or not? It's very important. There are those investors who have, when I started posting on financial, they said that they are not in finance. They may not understand. Even me, I'm not from finance. I'm from technical side, but I have privilege of working in finance department. I won't say which company, not AIB, but I won't say which company. And the things that go there only the accountants know. There is reporting for regulator and investors, and reporting for the company. Those are two different. For investors, they just do it just to spice the market. But for directors, they need to see everything. Most of those you find accountants, they are not able to hide the real data. That's why you need to identify whatever is reported, is it real or is just an accounting profit? So again, is it real profit or they're just reporting for accounting? As I said, I don't want to talk much of where I've worked, but I can tell you there are companies which do that. Just fix numbers to report profit. That is not it. In this market, companies which are listed at NSE, if they do that one way or another, they'll be caught. So how then do you tell whether profits are real or they're just accounting adjustment? When I say accounting adjustment, any accounting auditor will tell you adjust this and this and this, but you have the actual, the real figures. It's the one you're adjusting. Maybe to add provisions and other things. So all profits you see, especially reported in this market, not all of them may be real. You need to dig deeper on the commentaries, because the commentaries will always expose some of these discrepancies. Then compare the companies which are related, like KPLC and Kengen, you can't hide. Whatever KPLC is reporting as debt, as I said, should be a creditor on. Is it a liability on Kengen? Unfortunately for banks, it's different. But you can tell if one bank is reporting huge profits and others are reporting losses, then why is this bank alone reporting profits? That's why you compare peers which are in the same sector. You can always tell. For Safaricom, unfortunately, there is no peer to compare, but you can tell with the usage. I wish Airtel were to report this, then there should be some similarity. So for real profits, it comes from the actual sales and operations. So again, as I say, we have seen whatever is reported on P&L should actually be mirroring what is in cash flow statement. If there is something that is off, then you can't report decline in profit in your P&L, but in cash flow you're reporting an increase. There is a discrepancy. Let me see if I think I've already closed. I would have checked. You compare 2024, 2025 profit after tax, then you go to cash flow. Are they on the same direction? If they are not, then there is a problem somewhere. It is reporting for paper. However, if they decline and you can tell even the ratio, that is the percentage decline or increase relates to both. That is, you do for P&L and you do for cash flow. And if you find it is similar, then that's okay. If there is a discrepancy, then there is a problem. That is reporting for paper. And again, in the reporting, unfortunately, as you have seen in KPLC, they don't disclose where this profit came from. That's why you need the actual results. It tells you where. I wish they usually give that. There is a time they used to give that booklet detailing their financial results. That's the one you need. You will actually tell whether these profits are real or they have just cooked. So for accounting profits, they usually come from the valuation of gains, assets sale, or just a one-time item like a sale of building. That is fixed in the results just to be there, but is it the actual profit that company have made? It may not recur next year or next year, but further. And the valuation of gain in assets sales and also asset revaluation, it's usually done by people like us. They just use a tentative figure. They just take a percentage and say, let's just put this. You see, that's not the actual. That's why I said for reporting is usually, it is accounting profit. It's not the real profit. Real profit, get that booklet. It will save your work. So as an investor, always be interested in profit that is coming from operations. That is cash flow from operations. If it is positive and growing, then it means profits are real. That's why I said P&L and cash flow statement, they should relate together. So if profits, the net profit is high, but if you go to cash flow statement, it's on the negative, then it's cooked books. Unfortunately, most of the auditors and accountants, they forget these because for them it's just about reporting. Remember, analysts, they go into details. So then why, if a company announces a strong results, why does it not affect prices in the market? Why does prices fail to go up? Huh? This happens mostly in NSE. You find a company have announced results like KPLC. It announced its results previous. Price was 14. I think it has gone back to 12. We would have expected this price to go up. And I think there are people usually argue that this price will go to 35. That's per technical analysis, not fundamental analysis. So this is where fundamentals come in. Remember, we have moved from numbers now to fundamentals. Fundamentals in Rayman is how healthy is that company? Profits justified. Our operations of the internal management issues so resolved. Is there governance issues? Those are the things now you start to, those are the ones which affect the market. When immediately market is affected, prices go down. It's not about the numbers. So for those we have had some back and forth on KPLC now, I hope now you understand why. One of them is market expectations. Stock market in NSE, and I'm not talking about global. Global markets is different. I'm talking NSE Kenya. It is moved by you as the investor. The expectations you have. It's not the results that a company announced. A company can announce good results, but on social media, we just see that company have a lot of issues. People want to sell to exit. Even if the results are good, prices will slam down. Huh? For KPLC, people expected the profit to be announced above what was announced last year. I think there are people, even we have had during the conversation, they expected high profits. But then you're forgetting last year, they reported the profits came from increased subscribers. But who are these subscribers? You know, I'm even right now, I'm still looking at those subscribers. I can't find them. Why? Even during the former President Uhuru, we used to have rural electrification where everybody was entitled to get electricity. It is still happening with the current government. So who are these new subscribers who just came in all of a sudden and got it and subscribed to power? It tells you something is off somewhere. Where they are taking power, it is in rural areas. In some of the estates, where you expect high ratio of defaults. Will these people first cater for their bills, other bills, or will they pay electricity? Remember, economy is not doing well. So me, I'm still looking at all those people who paid that amount. And it was actually justified by, my argument was justified by the results they announced. They announced a reduced profit. Hopefully the next year they don't announce a reduced profit, because then it will deter on books of accounting. So most people for KPLC, they expected a huge profit. And these may have an effect. We have seen prices go down to 12. Hopefully it doesn't go below that, because it is come dividend. We'll come to that. Come dividend means share is trading within the dividend period before book closure. We'll come to that. Well, I would have expected the price to go up, actually up to 20. And I think there is a post I did on my WhatsApp community. Let me see if I can share that link for those who are not in that WhatsApp community. It's that one. Huh? That's the WhatsApp community. I'm trying to migrate from WhatsApp channel to WhatsApp community, and your number is not exposed. Huh? So don't worry when you join. Huh? Your number is not exposed. I've taken all caution. It's not a group you're joining. Huh? You know, in a group, everybody can see your name, your number, full number. In the community that I've created, unfortunately, you can't see, unless somebody is in your contact. Huh? That's the only time you can see them. If they are not, they can see your numbers. The reason is I don't want people to join because I want it to be open. This is not for IB. I want it to be open for everyone in Kenya and globally, where we run together. So that way I don't want to expose anyone. Huh? So in that, there is a post I had done. I can't remember it's which one. I wish I could quickly see it. I think within this week or last week, there is a few days I've not posted as I was dealing with the migration of the system. I said analysts, they give you a recommendation. Buy Safaricom. So buy. Then they give you a target price. So there is current price, there is target price. I don't want to share any report. I don't want to expose any of the analysts out and even other brokers. There is current price. And I saw for KPLC, current price is 12. Target price is around 15, 16. And I was asking myself, where did they come up with this 15, 16? It's not raw calculation. KPLC is calm dividend. We expect the price that is given, price to go up. And that's why I was saying, I wish we could ask those analysts, how did you come with this price? It is given. Then they will take credit that they made a positive recommendation, but is there a positive recommendation? It's given. Any share that is trading on dividend, calm dividend, price will go up until closure. That's why I say before you get into any share that have issued dividend, always check market expectation and also its other fundamentals. We'll come to them so that you don't buy a share because you have been told to buy, it is on dividend, price goes up, you don't sell to get capital gains. Then the following day after dividend, ex-dividend price comes down. Remember, even if price goes up and you don't sell, you're not gaining anything. The market, huh? You only gain when you do the actual sale. For dividend stocks, we always advise don't sell because even if price goes down, you have not sold. It's not a realized loss. Huh? It will come up again. But if the company is not supported by fundamentals, so the next thing to look at is the future outlook. Huh? What is the company planning to do next? Like for Kenya Power, I would expect the target EV sector, that is electric vehicles and the new innovations that are coming in. They should be looking for that. For banks, they should be thinking of giving us other products, not just savings. They should be expanding. These days, everybody is on social media. Why can't you buy using your WhatsApp or your Twitter or your Facebook? Why can't you pay directly using your bank without having to exit? Using the same, let's say your WhatsApp. You are chatting with somebody, they tell you, I'm selling this is the amount you need to pay. Why do you need to get out of WhatsApp, go to your bank, pay, then come and confirm? Can't it be done directly on WhatsApp? These are banks to innovate, it's not us. Huh? So you always need to check this. Like if a company maybe announces good profits, and in their report they say there is a slow reading. Yeah? You may find we panic when you want to sell. Prices will go down, even if results are good. Panic selling will push prices down. Huh? Then external factors, and this is the most factors that affect NSE. One of them is inflation, because it will affect spending power for investors. Huh? So you find there is no much of activity. People want to sell to take a profit. Huh? Taxes, they affect the companies. Operations, again, profit reduction. prices go down. And very important government policies. They may of it. Hopefully now with from next year, after elections, that is from 2027, we will see a shift in that, where politics doesn't affect market. Because even if a company announces good results, politics will always affect that company. A good example is a KPLC previously. It was just politics, that's why they were reporting losses. All of a sudden, profits, giving dividends. It didn't happen out of moon. Everything is out there. That's why I said always criticize everything you see out there. If you criticize using what you can see, not what other people are saying, what you can see, you can tell. I don't want to disclose that, because again, I'm not a politician, and I never want to go into that field. I know it is risky, but for KPLC, you can tell from the time they started announcing the profits what happened in between. That's a homework for you. But for those who have come before, they already know what happened. For example, just to spur your thinking, KPLC. Right now they are reporting profits. But most of them, even if they are saying, and that's why I said, I'm still looking for those subscribers who paid that amount to make that revenue. It could be revaluation or adjustment of tariffs. But when they are reporting, they don't report it as a revenue from the adjustment. They report it from increased operations. If you don't interrogate these, you always think this is a profitable company. So always compare cash flow, debt levels before judging performance, especially for these government-owned companies. They usually hide their debts and they project cash flow just to make sure it aligns with their P&L. Safaricom, on the other side, profits, we have seen they always report good profits, and at times they give a special dividend. But is their price synonymous with that? They have reduced growth in Kenya. I think most of, and this again is politics. We are moving to Airtel. Why? You have bought shares in Safaricom, you want to move to Airtel. So you don't want to support the company you have invested, your shareholder. You want to go and invest in another company that you're not even known. Remember, Safaricom as a shareholder, it's like you own it. Through growth, reduced profit, we don't give dividend. Then we want to complain. Yeah? Politics, we are told boycott Safaricom, let's go to Airtel. You are a shareholder. It's like me telling you, don't go to your house, go to the neighbor's house. Support them. Are you building your house? It's the same thing here. If you're moving from Safaricom to another subscriber, even internet, you don't want to use Safaricom data, their Wi-Fi. You want to use another cheaper one. Yet you're an investor in Safaricom. Remember, when you buy shares, you are an investor. You need value for your money. You need to support that company. Also, they are doing expansion. So in Ethiopia, that may eat into their profit. Because remember, they're investing in a country that they don't have a base. They are starting from scratch. Before it peaks, it may take a while. So that time, it is Safaricom Kenya that is supporting its unit in Ethiopia. We saw it with DTB when they closed one of their unit, I think. Was it Rwanda? When they closed that unit, it's because the unit in Kenya is the one supporting that fully. So it is eating into their profit. Why not sell it? Because it is a liability to them. Huh? Then there is Equity Bank. Equity Bank is one of the strongest banks. They're in the same league with KCB. They usually compete in terms of growth. And you can see even in price and also dividend. But you find, even if it is a strong bank, prices will still fluctuate. Why? There is interest rate caps by the central bank. Government introduces taxes on their earnings, that is on their loans. That eats into their profit. Right now, economy is a bit low. Most of banks, they are being hit by the loan defaults. Remember, the provision for that. When people don't pay, remember, they don't have money to pay their employees. They have to get back into profit they are making to pay out. And some of us, because we are given a leeway by CRB, you don't even need to worry. When you default, you go for many years. That loan, maybe it's not performing. At one point, they will even shut that interest calculation, meaning they are not earning from the money they gave you. And us waiting for dividend announcements. When we anticipate there will be a dividend, we first withhold our buy orders. That pushes prices down. So you may find even if company is strong, prices are not impacted with that growth. So for some banks, always, first of all, again, from their full results, that is the book rate, check their own book quality. Do they have high default rate? Who is taking loan? Is it individuals or it is the government? If it is government and entities, default rate will be low. If it is individuals, then default rate will be high. Net profit ratios, and again, also management, what management says. So what should matter to you? First of all, profit margins. Profit margin is how much profit made for every shilling of sales. So it is net profit divided by revenue times 100. The higher the margin, it tells you cost control is in place and also pricing power. So these are something you need to check. Remember, there is no analyst who will do this for you. You would need to do it on your own. I have not seen, apart from now from return on equity, I can say IB is also giving this. Return on equity, ROE, you can find it on that table I will show you on Daily Market Watch. It will show you how well the company uses shareholders' money to generate profits. Remember, you are a shareholder. So how does the company use your money? Remember, you bought from somebody else whom you paid. So somebody wants to sell their shares, you bought from them, you didn't buy from the company. So how then is this company using your money? Remember, this person who is selling to you may have bought those shares during IPO. So they gave that company money to go and invest. So those investments, they are the ones that are generating income. So you came, you paid them because the company can't pay them directly. It can't sell whatever investment they did to pay them. They come and sell in the market, then you buy. So you are replacing them. It means the amount they have invested, it now becomes a portion of you. You are part of that growth. If it makes loss, you are making losses. If it makes profit, you are making profits. So the formula is, again, net profit divided by shareholder equity times 100. And we said shareholder equity is what? Net asset value of the company, which is total assets minus total liabilities. So this you can get from balance sheet, the difference between net assets and total liability. Remember, it is either shareholder equity or equity. So net profits, you divide by that. And this, again, it's already there on that report. It's done by our researcher. So if you notice the REO, the ROE, that is return on equity, is consistent and is above between 12 and 15%. It means strong management performance. it means that company is using your money to generate enough profit. It is a strong company. So for those who have been asking, how do I know a growth company? These are some of the things you do. Then there is a return on assets, ROA. It measures how efficient assets are being used to earn profits. Again, P&L, net profit. Then you go to balance sheet, you take total assets, both current and non-current, then times 100. Because then if ROA, that is return on assets, is low, then it tells you profits are thin. And when doing these ratios, and even the ones that we have run, always compare companies in the same industry. You can't compare Safaricom with a bank. There is no relationship. You go to KPLC, you're trying to compare with agriculture. It will be off because each is affected differently. But if they are in the same industry, whatever affects one has the potential of affecting the other. Default on loans on equity. You also expect those to affect Stanchart and others, but it won't affect Safaricom and the rest. Because Safaricom, it has the data, it has the voice, and it has M-Pesa. Even if within M-Pesa they have their own facility, it is not the Safaricom or M-Pesa that does directly. They have the underlying providers, most of them were banks. So there is also variation ratios. I won't go into details because I want to go to the other slides. P ratio, that one we went through and we went through financials. There is dividend yield. Dividend yield, it will show you how much income, that is the dividend you earn per compared to the share price of that stock. So the formula is the dividend per share. Let's say it is KPLC, it is 0.8. Then you divide by its share price, which is around 12 point something, then times 100. So again, dividend per share that you can get from NSE price list when it is announced. Share price you can get from online and mobile app, then times 100. And these will keep on changing daily. So the yield you keep on changing daily. Why? Share price. So like now for KPLC, the dividend yield on Thursday is not the same as the one that will be on Monday because the price will have changed. That's why you need to track it on daily basis. So a higher yield, it means higher returns and steady income. Those are the companies you need to watch. But again, most of them you find prices again, they are high. And also check how consistent is that yield because it tells you even in future what will happen. So even if yields are high but prices are going down, then that could be a warning sign in future. Then there is a price to book. I think these we may have touched previously, but it compares market value of a company to its actual net worth. Again, net worth we have said is assets minus liability. You can get that in balance sheet. Market value of the company is the share price. So the value, price to book ratio, the way you calculate it is share price divided by book value per share. This, I think, again, it is calculated by result, but on Wednesday now we should be able to do it in the Excel. Then I release that Excel template to you. After you create your watch list, at the end I will show you how you can create watch list. Using that watch list, you can feed those shares into the Excel spreadsheet, and you'll be able now to track these ratios. You don't want to track everything because you get confused. And for those who have been asking whether a share is overvalued or undervalued, this is what you use. But then there is also price to earning to growth ratio, PEG. There are so many ratios, but I don't want to confuse you with this today. We'll do it on Wednesday. But again, these are technical analysis. You need fundamental analysis to support your technical analysis. So then what do analysts look before they tell you buy and sell? It's the same ratios, but support that with fundamental analysis. One of them is profitability trade. Margins, RE, ROE, ROA, are they improving over time? That's why you need to compare over time. Valuations, you compare with peers, companies within the same sector. You check, is this cheaper or expensive compared to others? Consistency of dividend, are they paying regularly? Because then a company may pay dividend now, it never pays again. A good example, Umeme. They just paid the dividend because they sold assets. And most of us, we went to buy hoping to give another dividend. Until they finalize the court case they have, we may not see any other improvement. Or they venture into other countries or other sectors, which I think they are doing currently. Then, growth of that company. What does management project? How do you know these when they are doing results? They usually call for investor briefing. That's when they tell you they are doing. Or even in their financial booklet. Then market sentiment, very important. What are the investors saying? You know, for us, we invest through social media. And if there is one place people lose money, is investing through social media. Social media, everybody is an analyst. Today I'll tell you buy, another one is telling you sell, another one is telling you hold. And all of us, we have support. Then comes a very senior person, maybe a well-known figure in social media. They tell you it is a buy. They come with their own support. You want to buy. All of you want to buy. And the share you are buying, profits are going down. Yet these influential figures, either they have been paid by another strong investor to push the prices up. You buy, they sell to you, they exit. And hopefully that's not what is happening with some counters. And that's why I said I want us to do it. Today we do spoofing, because that's what most people are doing. It's very hard even for regulator and NSE to spot that. I've told you what we have seen them investigate is small investors. 100 shares, you can't tell me somebody is using that to spoof the market. Even if they cancel that order a million times, that's not somebody who's playing the market. Those who are playing the market cannot, and I repeat, cannot be found that easy. It requires a lot of analysis. Like last week, Safaricom, somebody was trying to buy 1 million shares. Something I've never seen in order. 1 million shares put, then the split is 2. Just 2 people. It was 1 million and some 2,000 shares. It would tell out of these 2 people, one of them is the one who have put 1 million shares. Just to show the market, spike the price, either to show supply that there is demand, so that they oversupply, push prices down so that he can buy at a lower price, or to show the market there is demand and tell suppliers to withhold shares, push prices up. And maybe the intention is not to buy, it's actually for him to sell. We'll see when we go to spoofing. There is the 2 ways. And that NSE cannot be able to track. Because I'll just place my order, I need to cancel it. And I'll put at the lowest price that can be seen on the order. I think it shows 5, so I put on 5th, where I know it won't execute. And when I'm pricing, I will also check on the splits and also the total number of shares above that price. If I know I cannot be hit, I put. Eventually, at the end of the day, it won't execute. If NSE asks me, I'll tell them I wanted to sell at that price. I don't want to go into details. I'll come when I think it should be in the next slide, so that you understand you don't get played with in the market. Eventually, you're helping somebody get your shares at a cheaper price, or you're helping them sell better profit. Then they leave you with a stock that you're not able to sell. So we go to dividend effects. Those ones I'll go quickly. Then we come to the last slides. How dividend announcements move prices. This is something else we as investors ignore. Dividend announcements have a possibility of moving prices. And I hope I'm still audible. Just put on the charts. Put on the charts. I can see the chart is a bit quiet. As you stretch, just put on the charts. Am I audible? Okay, because I've seen the chart is a bit quiet. Okay. So this is the most important part of this lesson that you need to understand. The effects of dividends, bonus, REITs on prices. Because again, people take advantage of this, make money out of it. I can tell you, Umeme, there's a client who had bought when it was low. He decided not to take dividend. He decided to sell on book closure. He made twice what he would have made with a dividend just by playing with the market. And this is what smart investors do. You play with the dividend. So first of all, what is book closure and ex-dividend date? So a company announces dividend. So in NSE, you see company X announced this day. So that's the day investors approved, that is the shareholders approved for that announcement to be made. It was sent to NSE for publication to the public. Within that announcement, they say book closure date is on this day. So what is book closure? It is the date when company closes its register. Then it uses that register to determine who will get dividend. So if your name appears on the record, that is that register in CDS, you are still a shareholder. You have not sold on that day. The total you have, it's what you get dividend for. So let's say Equity Bank announces dividend on today's date, 18th. On date 18th, they announced dividend. Then they say book closure is on 30th October. Between today and 30th, you still need to buy shares. If you don't have, you can buy. If you have, don't sell. The total you have on 30th October is what qualifies for dividend. So if you sell in between, whatever you have sold will not be paid. If you sell everything, you're removing yourself from the register, and the new person who is buying is the one who is getting into the register. On 30th, 3 p.m. market closes, CDSE balance. By 5 p.m., the total number of shares you have is what qualifies for dividend. So that is on book closure. I hope now it is clear. Ex-dividend date is 1 day after book closure. So 31st October is the ex-dividend date. Because remember, book closure we have said is 30th October. So on 31st October, it's called ex-dividend date because it's 1 day after books have closed, 1 day after register have closed. So I hope now we are relating. These names, they all relate to the same thing. Book closure, we are closing books, we are closing register. It's only that this book or register is in digital format. So ex-dividend date is 1 day after. It's like our ex. Somebody you have forgotten. So it's 1 day after you have forgotten about dividend. If you can relate that. So it's one trading day after book closure. So it's not like today is a weekend, so it won't be calculated. So it's only trading days. So even book closure is on trading days, but it is usually posted on the NSE announcement. So if you buy shares that day or after, that is one day after. So in our example, it was 30th October. So you're buying on 31st October or going forward, you are not entitled to dividend. Remember, you are not in the register. If you sell, you still receive your dividend because on book closure, when the register was closed, your name is there. It was submitted to the register. So you are selling after register have been submitted. So two things. If you are buying after book closure, you won't get dividend. If you are selling one day after or after book closure, that is one day after, then going forward, if you sell, you still get your dividend because you were in the register the previous day. So it is the investors who are in the register on book closure who are entitled to dividend. On next dividend date, nobody is entitled for dividend. And what happens to prices? On next dividend date, prices, they adjust with dividend amount. It's called dividend dilution. Because the new investors who are buying, they are not entitled to dividend. So why would they buy you at the same price? So you factor dividend out. That's why it goes down with the same amount. But again, we, the investor, we forget ex-dividend date is open day. If you have gone through my YouTube channel, I went through these. Most of the investors forget ex-dividend date is open day. And open day means in NSE, you are not limited to 10% rule in terms of buy and sell. You can buy at any price, you can sell at any price. It's only the maximum price that is set. Lowest price is 0. So if somebody comes and places to sell Safaricom, to buy Safaricom at 1 bob on ex-dividend date, and you are submitting a sale order, market price, you are saying market instead of limit, there is a possibility you can sell at that 1 bob. Then within the day, the block is broke maybe at 15. You see, you have gone at a loss. That's why ex-dividend date is as important as book closure date. Book closure, you sell, you're removing yourself from the register. Remember, at book closure, prices are usually high because people want to lock in dividend over demand, push prices up. Ex-dividend date, dividend dilution, price goes down. It is open day, you want to buy, you just put your market order, somebody realizes then there is no supply at that point, somebody will come and put a limit order at the highest price and they'll get their profit and move. So that's why it's very important to know this data. I'm happy to repeat this on Wednesday as much as I can until it gets into you because we have had issues. Ex-dividend date, somebody is asking, why did I sell my shares at 1 bob yet that share traded at 100? It's because you didn't check market depth. It has all the prices. If you go to market depth, then you realize there are no, if you want to buy and there is no supply, don't try to place a market order. You'll be hit. It very easily. There are people who are waiting to see that, especially if you're dealing with, unfortunately, Dosika and my stocks app. Those ones, they are offline. Yeah? Traders can see what you're submitting before it goes to the market. They can hit you. They will just submit the order and submit yours. You'll be hit. For the digital platform, market order, if it goes to the market, it doesn't get anything to execute, it cancels. But remember, there are people who put the highest price possible that day. Then the others panic, they don't want to put. You are putting to buy it market to hit that price. Then you'll be wondering, why did I buy high? Maybe at 100, yet the share is trading at 10. It's because of those issues. An open day is not just ex-dividend date, even ex-bonus date, 1 day after bonus. Or when companies are announcing results or when companies are announcing profit. So I think I need to do a full video on open day so that you also know it is also a day that you can buy at the lowest prices. Especially if you're getting into the market before it opens, you can hit a lot of people. That's the time you can buy at discount, and that's when you find most investors are in the market, waiting to see the opportunities. So why then prices rise before dividend and then fall after dividend? That is, term dividend, like KPLC is term dividend, until they close the books, I think around 2nd December, if I'm not wrong. So that time it is dividend. Prices will go up. Book closure date, price will be at its highest. Then after book closure, price may slam down. No? And this pattern is predictable. Dividend will always create excitement, but you can, as long as you know that pattern. Come dividend, prices will start going up until book closure at its highest. Ex-dividend date, price slam down. Then the following day after ex-dividend, price starts to readjust, stabilize until payment day. Payment day, that's when they stabilize completely. Most people have been paid out. Then after that, fundamentals kick in. It's around the process. It's around the topic when you're dealing even on dividends. I think for those who have come, we are in session 13. And if you go to my YouTube channel, the last 12 videos I've done, there is no repetition. Huh? So it can tell you how much you need to run in NSE. And I'm yet to cover everything. I think my year of experience in NSE, this is 2007. We are in 2025 or 7, around 18 years in the market. Huh? And I'm yet to see a lot. There's a lot. Actually, spoofing, I just realized the other time. Huh? I also thought there is no, I even used to defend our traders that there is no market manipulation. Until I saw it. Spoofing, we are coming to it next. So before dividend, you want all to buy to lock in dividend and qualify. So you want to buy. Those who have shares want to hold because they also want dividend or capital gains. So they want prices to either go up or they lock in dividend. So they don't want to sell. So we will keep on pushing prices up. So that's why before dividend, you find prices going up, including book closure. Because at book closure, the seller have two decisions. Do I want to take a dividend or do I want to take capital gains? They have an option of selling that day and buy the following day when prices go down, but costs, will they make difference? Or do I take this dividend and continue accumulating dividend? Remember, there are those people who are on wealth building, not capital gains. Wealth building, you just buy. You only take a few profits here and there. Capital gains, it's a decision you make. Do you want dividend or do I want capital gains? Remember, not everybody is after capital gains. They after wealth. They won't sell. So prices hit their highest. Then after dividend, book closure passes, then you're in next dividend. Share price will always, and mark my word, always drop by the same amount of dividend or even lower. Why? Because that day, market will open, prices will be zero to the highest. The highest is determined by the previous price minus, that is price on book closure, minus dividend amount. They do 10%, that is the highest. So the highest price is tagged to that, but the lowest is 0. So 0.1 up. But remember in the market, I believe you can put a 0.1 price. I've seen those, there are people, investors who are crazy, they put, because they know there's a possibility there will be no other orders in between to buy. You want to sell market. They know their client will, we want to just sell immediately. You'll be hit by 0.1. And you'll be wondering, how did I sell my Safaricom at 0.1? It is trading at 20.25. You see, you have lost a lot. So that is called dividend dilution, where prices go down with the same dividend amount, because the new investors who are buying after dividend are not entitled to that dividend. And this is not market manipulation, it is normal. Why? Company have already distributed its part of its value to shareholders. Prices needs to readjust to its correct position. It's usually not a loss, because one, you have not sold. You only realize loss when you sell. Even if you see red in your portfolio variation, you have not lost. Number two is just the readjustment. Prices will improve if there is positive sentiment and fundamentals. That is, whatever supports the company in its operations is real. It's not just figures. That's why me, I'm never interested in technical analysis, because that can mislead you. And then your company is undervalued, but is it really undervalued? If I was to ask you, is Safaricom undervalued? You say yes, and you'd want to buy. But what is its price? It's at 1.20 to 40. Why did it go back to 20 if it is still undervalued? KPLC, we are still arguing in farm. The price is around 35. It's supposed to be 50. It just came from 1 bob to wherever it is, 14. Now it is going back to 12. What magic happened in between 1, 3, 14? And these are things smart investors will play with, spoofing the markets. It will shoot the prices up. NSE will never realize, because if they go to broker will tell them this is the order client gave. They go to the client will say, yes, I wanted to sell, but I decided the market didn't sell for me. Who is the market? It is NSE. You see now blame goes back to them. And they can't move prices in favor of that client. Then there is we have talked about come dividend. What is it? Is that duration when dividend is active for you to qualify from the time it was announced to book closure. You see on NSE price list something CUM on top of the name. It means that share is trading come dividend before book closure. The question, and the big question, should you buy a share that have announced dividend before they close books? Because that's the question you ask yourself. Do I buy that period or do I buy after? You need to, again, on your own, to analyze and ask yourself, is this dividend enough for me? Because if dividend is small, then price drop after book closure will often wipe your gains. Remember, even if it will fall with 50 cents, for this example, it is an open day, it might even slam down with 10 bob. Is the dividend worth that loss? That is, if you're looking for capital, if you're looking for where that dividend is even enough, because you use it to buy other shares. If you're not looking to sell your shares, then you don't even need to worry about all these I'm talking about come dividend. Your work is just to buy. If you're looking for capital gains, these are the questions that you ask yourself. Do I sell on book closure, take my profit, buy another share, or wait, I take my dividend and reinvest? Those are decisions you make as a short-term trader. As a long-term trader who is working on wealth building, I've done a full video on that. These are things you don't need to worry. So for you to make wise decisions in the market, make them even before announcement. You already know these companies announce dividend. So why wait until they announce? Start buying early when prices are low. When prices fluctuate, buy. accumulate. Don't sell. You wait for the dividend. That is if you are looking for wealth building. When you receive that dividend, don't use it. If you have expenses, deduct from it, but majority of it return. It is free money. You have not sold shares, you have received free money. You're using that free money to buy another free money by buying another dividend stock. Stagger your dividend as much as you can. Have as many stocks as your investment amount can allow. We are coming to how to create a watch list. Have as many dividend stocks as much as you can. Why? If you start building your wealth now, you are just reinvesting those dividends. As I've said in that wealth builder, by 5th year, that's when you start seeing some returns. It is the same thing with pension. Pension, you won't see returns at it. 5th year, 6th year, from 5th year, you start seeing some returns, some good compounding. But now, unfortunately for shares, for it to compound, it is you to do it automatically, manually. Return that money back and buy shares. It's not a pension where the amount keeps on rolling back. Principal plus interest earns another interest. In shares, dividend, you have to invest for that dividend to buy another dividend. Now you have a new principal. That principal plus your new dividend will give you another dividend. Use that dividend to buy shares and add again. By 5th year, you should start seeing some returns. In the 10th year, your stock should be paying you like a salary in terms of dividends. No matter how much you are putting, it should be giving you some good amount. If you do it consistently, in your retirement, you will not even think about your pension. You take your whole pension, put it in share, so that you start getting dividends every now and then. Imagine getting dividends early in the year, mid-year, and end-year, and you have not sold your shares. It's the one that is supporting in your retirement. Then you distribute that wealth to your children. I've done full videos on these. Pass it to the children. They are not starting from scratch. You're giving them already built wealth. Maybe that time you're a millionaire. You're passing millions to your children. Even before they start working, they're already a millionaire. Show them how to grow this wealth. And that's how most of millionaires have grown in the market. Hopefully, I'm not challenging you. There are those who have already started investing for their kids. Yes, in NSE, we have minor accounts. Those accounts, when kids turn 18, automatically they become normal accounts. You start investing small amount, 1,000. That 1,000 you're investing in a dividend stock. That dividend is paid to a Jumbo Junior. Jumbo Junior is earning interest. As you wait for market to go down, you have some interest. Return that money back to the same Jumbo Junior. Buy another stock, a dividend. So you used your dividend to earn interest. Then you used that dividend plus interest to buy another dividend. That cycle, by the time you're passing that valuation to your kid, they might not even need to be employed. They can become full-time traders. Dividend is covering their expenses. So very important, book closure date, ex-dividend, long-term performance of the company. Those are things you need to know. Timing in the market is key. When market is down, that's when you hit the market, especially when there is any results. Open day. Any open day, if you have some cash, be ready. I've said which are open days: ex-dividend, ex-bonus, ex-split day. Then there is results announcement day, profit warning day. Those are open days. Those are the days you need to hit the market in full. Then when we go to election, most of us usually panic. But hopefully now going forward, the political environment change. We don't see what we have seen previously. And I hope our the Gen Zs may understand what they will do to the market. If they understand and we have a good political environment, we wouldn't predict a slump in the market. But again, it will depend with the politics that will be played. So psychology of dividend hype. Again, we always buy using the hype in the market. Dividend is good. On social media, it's good. You want to buy because somebody is telling you on social media. And dividends are the biggest emotional triggers in the market. You find people want to buy to lock in dividend. So we rush in this social media. Actually, that's the time people will start even doing free marketing for a company. You find like Safaricom have announced dividend. We are actually doing free marketing for them by announcing their dividend. But what are we doing to the price? Price jumps. There is somebody who may even pay those social media influencers to just do that purposely to push the prices up. They are looking to exit on book closure when prices are. You want to buy on book closure. Somebody have taken profit out of you. Remember, they are gaining from you, not from the company. They are selling to you, you are paying them money. The company is nowhere in between. Huh? So during the hype, not everybody will make money. Some will lose because of that. Because we don't understand the psychology behind these hypes. If there is anything you need to ignore is social media noise. Always validate everything with NSE. Anything that is not coming from NSE, ignore it. If somebody tells you this dividend is good, ask yourself, why am I buying this company? Do I even know what it does? What gains do I start to gain? Am I only looking at dividend or even capital? Those are things you start asking yourself. So the way it works in the market, there is the excitement phase. It is usually before book closure. We call it did come dividend. That time everybody is excited. You want to buy, you want to buy. You see, even like now, we are going to, we have KPOC. You see so many groups even coming up supporting KPOC. And we want to buy. But then prices are still going up. If somebody is not interested in that dividend, they will hit you when you're buying at high price. They take their profit. The following day, you panic. Remember, you have bought at a high price. Price goes down, you panic, you want to sell. The same person now buys at a lower price. He made money out of you, not from the company. He made money from you. Because you're investing using emotions. That excitement phase, most people lose money. Always enter early. When if you want dividend for Kenya Power, if it is Kenyan, it is time to buy. Don't wait until announcement, because immediately announcement is made. That time there is excitement. Right now, most of the investors, they have already known some of these things through these trainings. I've seen now most of us, they are going to INM Bank. It will be giving dividend November, December. They want to locally. But again, that emotional investing starts to drive prices. Then after dividend, that's when reality checks in. When dividend dilution happens, and you realize you bought at a higher price, you want to sell. Hype have faded. Nobody is even talking about that dividend. Most of them, they are talking about how they will receive that dividend. Price drops. Then you panic because price have dropped. Because you are listening to the same noise. Price have dropped, but you receive. Can I sell now? Can I sell now? Can I sell? Yes, you can sell. You are selling at a loss. The person who is buying is the one who sold just the previous day to you. Because remember, cash is available the following day to buy shares. So you sold at a profit to him. He's buying at a lower price. And he will repeat this every now and then, making money out of it. But the market, it has its own, I hear people calling it karma. Their cost you are incurring indirectly without know. Even if you're making these profits, if you calculate your costs, you may find you even went at. That's why I always advocate for wealth building, long-term wealth building, not short-term wealth building. So we got to short-term versus long-term traders. Short-term is just anyone who is speculating in price movement. You buy when hype begins before prices go up. Then they will spike the price. As I said, there is spoofing and there is that excitement through social media. Unfortunately, even the players in the market, NSE, they are also playing into that hype. Brokers, again, we come in hype. Because remember, brokers and NSE, they are making money through your trade. If you don't trade, they don't make money. Why not hype for you to trade? That's why when you ask me, do I buy this? I always ask myself, am I advising you as an AIB staff or as an investor? I will always take the investor stand. Because there is no need of you losing when AIB is making money. While you can wait, you still earn money when you buy at the right time. So short-term traders, they use hype and also creating those short-term price triggers through spoofing. So they buy when low, sell when high. They are targeting capital gains. Their goal, they will not even think about dividend. They think about price movement. But then it's very risky. Their cost you are paying. You may buy then the share. You're expecting prices to go up. Something happens, price goes down and sticks there. And he rose. So for short-term traders, is very, very risky. Long-term investors, them they think dividend and wealth. They don't think about time horizon. They don't think when they will exit. It's just buy and buy good counters that are giving dividend. Then those counters, when they start paying you dividend, you now start even buying other stocks which are also offering low dividends. You start building your wealth, looking at how you pass it to your children. In this call, who would not want to pass $1 million to their children? That child is not coming to go and start hustling with a CV out there and getting all the, what we go through when we are looking for a job. Them, they are coming, you have screens there in the house, they are tracking market, their work is to trade. There are people who do that. There is a time AIB we used to have a screen in our customer service lobby, and there are people who used to come there just to watch the market. Because that time they didn't have smartphones to track the market. And when they see a spike in price, they want to buy dividend stocks. And you ask them, then how do you manage to pay your bills? They tell you the dividend I'm getting is more than your salary. Whatever you're getting in 1 year, I'm getting 5 times from my dividend. And when you do mathematics, you can check even the portfolio, you can see it is true. And they build that role. And for long-term investors, they don't even worry about prices. There's something called dollar cost averaging, where you buy irrespective of the prices. But when prices are high, you don't buy a lot of shares. You buy small. Then when prices go down, that's when you compensate and buy many shares. So your cost averages down. So when market goes above your average price, then you're in break-even point. I've done that full video on that channel. I will share that link when I come to Q&A. I hope I will remember for my WhatsApp channel. It's for Gentle Side Studio. It's not for AIB because I'm doing other trainings outside AIB. And I think so far what we have I have explained, you don't expect any broker to tell you. When you go to spoofing, then you'll understand why a broker would not even want Peter to talk about it. So as I was saying, target dividend stocks for wealth, because that wealth you can pass over to your children. And NSE, treat it as a wealth builder, not a capital builder. Because capital growth have risks because of panic selling. Wealth building, you're not even thinking of how you sell. Shares will be there as long as that company is still listed in NSE. And CMA is still there, and CDSE. Your shares are never held by broker. Broker holds your cash. When you buy, they pay CDSE. CDSE credits your shares in your CDSE account in their system, not in broker's platform. So cash is in broker platform. When you buy, broker transfers that cash to CDSE to pay the person who sold to you. Then in their platform CDSE, they move shares from the seller to the buyer, still in CDSE, but tagged under a broker. Remember, you can't trade directly at CDSE. That's where NSE comes in. That's where market trades. So that these two entities don't let broker play with your shares comes in CMA. Then there is that company you hold shares. Those are the only entities you need to be worried if they go down. CDSE, NSE, CMA, and the company you are investing in. For a broker to go down, that should not even worry you. You only need one form, fill in, it's called transfer form, give it to CDSE, they move you from that broker to another. Shares doesn't change the number of shares. Valuation doesn't change because it goes with the current price. So you remove as if nothing happened. No cost of transfer. For that time, it is the CDSE who are facilitating, it's not the broker. So then when do you know when to trade on hype and when to exit? This is just for short-term trader. And apologies for those who may be thinking about short-term trading. I don't usually train on that. I don't train because you can lose money. Broker will not tell you because that's how they make money. Me, I would actually be very happy if you ask me, can I do short-term trading? Every trade you're doing, I'm making money. EIB is making money, it's paying my salary. But remember, you are losing. So when do you ride on it? When dividend is exceptionally high compared to the price. Dividend yield is very high. That time buy shares, ride on that hype. When sentiments are strong and financial results supports the dividend. So don't run on the dividend while financial result doesn't support it. Profits are declining, but there is a dividend which is higher than the previous one. Something is rough. I don't want to talk about KPLC here because it is still in dividend. It's a good counter. And always enter early before others start reacting. This market is driven by market reaction. When then do you exit? When price jumps very sharp, like KPLC. If right now the price goes above 18.20, why do you still want to hold this share which was trading at 3 bob for a very long time, company which was making losses? You may want to take that capital gain. It's better you regret you took capital gains early than regret at one point your share was 1 million value, it slammed down to 100,000. It's the worst thing that can happen to you in the market. For these shares which are not supported for a very long time with fundamentals, risk them for speculation until they stabilize. When social media buzz is at its highest, when people are excited, actually look at Facebook, look at how people they are reacting. That's when you find smart investors, they want to sell quickly because they know people want to buy in. Even if prices are high, they will hit you, take their profit. With the following day, you panic, sell low. When we are making losses, they are making profits. And very important, when fundamentals and not technical analysis don't justify the excitement. Fundamental. I always don't talk about technicals because I've seen them. Those numbers don't project what you see. That's why I would want you to have your own Excel. You do it when you start comparing with what you see on social media. So only look at the fundamentals. Technical is just to tell you what mathematics expect a company to do. But is the mathematics the one that is running that company? I don't want to use a good example. It's like a CEO who is using ChatGPT to run a company instead of running that company physically. Those are two different things. ChatGPT will look what Safaricom is doing. It is advising a CEO from a bank how to run a bank. That will be off. Where this CEO in the bank, if they were to look at the other banks how they are running, they'll be able to make informed decisions without relying on a software. It's the same thing. Technical analysis is mathematics. It doesn't project the real picture in the company. Fundamentals is the last thing you want to work with. Let's take an example. Safaricom, KPLC, they have already announced a dividend. If you notice there is a spike in price with 30%, that is KPLC is on bull run. Bull run is when prices are going up with a high percentage. Bear run is where prices are going down with a very high prices. It happens on individual stocks or market. For market, you usually use NSE share index, 20 share index. It's one that measures performance of NSE. And also NSE or share index. It involves all the shares. NAS 20 is top 20, I think, in form of, is it pricing? In terms of pricing, because price is what determines the bear and bull run. Not capitation. Capitation is NSE 25. There is also NSE 10. So if you notice, there is a spike in price with 30%. That is speculative buying. People are just buying, thinking they can lock. But there are no fundamentals to stand. Time will always tell, because after some time, prices will readjust. Hype will red. Then you're left with a stock you don't want to sell at all. So we go to the last. This is the most important slides. Let me see at the timing. Oh, we are still within time. Hopefully you're not tired. Let me see on the charts whether you're tired. Do you call it a day? Let me see on the charts. Just tell me on the charts how we go on. Huh? And I hope you're running something. Huh? Okay. Let's continue. So we come to the most stock, because I call it a stock. ETF is also a stock. But I will explain what an ETF is. That is exciting the markets. Again, spoofing and market excitement. We want to buy something that we don't understand. It is the most expensive stock in the market. You put money in. You are not even projecting, am I buying this for capital gains? Or why am I buying this to gain? How? Most people think you are buying gold. Then when prices of gold outside goes up, you can sell. It is not even related. Yes, it is tracking price of the gold, but in NSE, as you see, it is the opposite of what it is expected to do. So gold are usually seen as a safe havens. You know, they are not affected by inflation and market uncertainty. But in NSE, it is affected by market uncertainty because of investor sentiment, as we see. In international market, it could be different. So people want to buy, when inflation is high, you want to buy gold ETF and lock in. So in NSE, it is called GLD, Absa Gold. If it is not there in your list, you just go to where you add scripts, or if you're on app, there's somewhere it says search or add script. You click on that, scroll down to GLD. If it has a plus sign, click on it. It ticks in green, save changes. It is added. So it gives you as the investor a way of owning gold without physically owning it. You are buying gold, but you don't own that gold. This gold is stored by Absa Bank, I think in South Africa. So when you are buying in NSE, you are buying a unit of that gold, but you are not owning. Remember, you're buying in NSE. It's the same thing. You are buying shares in a company, but you don't physically own that company. So if you understand that, then even in Absa Gold, you understand you are buying a gold, but you don't have those physical bars. You don't go to NSE buy them gold with the coins or bars. You just own the digital unit of that gold that is trading in the market. So then what is a gold ETF? An ETF is exchange traded funds. For those who know funds is where you give money to your fund manager, they go and invest wherever they invest, then give you returns. Exchange traded funds is those funds you're investing in with a fund manager, but they are trading in NSE. You're not giving money to a fund manager. You're buying directly from an exchange. So ETF is a security of stock that tracks performance of something else. If it is Absa Gold, it is tracking price of gold. If it is ETFs for shares and stocks, they track the underlying stocks, group of stocks. So they track index of a stock or a commodity. So think of it like when you go to market, you can decide to buy individual items, fruits, cabbages, those are individual stocks. Or you may decide to go to a supermarket where they have already packaged into one bag. You're buying that one bag, but inside it has all the items you needed. So you're buying that one bag at a certain price. It's the same thing with the ETF. You're buying so many stocks inside at a single price, not the individual price of each. Same thing with gold. You're not buying the physical gold, you're just buying a unit that is tracking the price of that gold. So you're not buying at the price of the gold. And these ETFs trade in stock exchange, just like normal shares. ETF, we have SMWF for Satrix. You can buy just the same way you buy shares. Tap on the order, on the code, it gives you market depth, you see prices, click buy, put units, number of shares you want, and the price you submit it, you just buy the same thing. So now for Absa Gold, it tracks the price of gold. And when you buy now these Absa Gold, you're not buying physical gold. You're just buying a unit that represents price movement of the gold because it is used to track that price movement. So that one unit will be backed by a real gold, but you don't own it. Remember, it is managed by Absa Asset Management in South Africa. It's not you. So the Absa Gold, it mirrors the global gold prices. So your price, ideally, it's supposed to move based on international gold price that is quoted in dollars. That's how it's supposed to work. In international markets, that's how it works. You notice the price of gold. If price of gold goes up, the price of ETF goes up. If price of gold goes down, price of that ETF goes down. But in NSE, it's absolutely different. It's the other way. So in NSE, you may find it is affected by exchange rate, but again, I don't think there is any correlation between the two. It's also affected by local demand and supply from Kenyan investors. So you would expect when gold price rises, let's say the 5%, you'd expect the same to reflect. If there is currency weakness or inflation, you'd expect that to be reflected in NSE. But again, it doesn't always move in sync with international. Why? Because for us NSE, as I said, we buy based on emotions. Like what is happening. Just one investor comes and buys that gold at 8,000. Huh? The current buy price is 5,000. You place a market order, it buys at 8,000. There is a difference of 3,000 shillings. Media will hype it up. People are buying this for gains, but it's only one person. And it is a mistake. I remember that day, it's one investor who made a mistake, placing a market order without checking. This is a counter that is not liquid. Liquid means it's not easy to get a selling seller to sell to you. And if there is, it's at a high price. So when you place a market order, it is it. Then the market, unfortunately, NSE will report Absa Gold moved with 3,000. That is just one person who bought, instead of placing the order at 5,000 and wait with others, he just put a market order, it was hit at 8,000. That just difference, it is looked like it is the whole market, it is everybody is interested in gold. Then us, because of that announcement in Business Daily, we think Absa Gold is a good ETF. We want to buy, we push these prices up. But why is it in newspaper? Why was it put? Remember, this is supposed to be a paid advert by somebody. So it means there's somebody working with media to push these prices up, push the prices up so that they can sell at a profit. Always be cautious what you see. That's why market depth is very important. So the difference between Absa Gold ETF and stocks, it is safe because it's not affected by inflation. Shares may be affected, but they have high growth. ETFs, unless it is explicitly stated, they don't pay dividend. Shares, most of them they give, and they grow in earnings. That is capital growth. So unless for Absa Gold you are looking at price movements, then there is no other way you can make money. Even if the price of gold goes to whatever price, if price is not moving in NSE, you will never make money. The spread, that is the top bid and top ask on the queue. If you look at the difference, for Absa Gold is usually wide, very wide. Where you see wide spread, costs are high because you'll be buying at a higher price. And again, selling is not that easy. So you always need to understand, why am I buying Absa Gold? If it is not for capital growth, capital gains, don't even try to buy. You're just parking your money there. When people panic and they want to sell, prices will go down. So will you sell at a loss? It's not like shares, where when announcements are made, you expect prices to go up or down. These, in NSE, as I've said, there is no information that is accurate. Just look for any research, unless they started doing when that article was done. We have never had any research on Absa Gold. So unless you are buying for capital gains, you will just be preserving your money, which will not give you any gains. You might even sell at a loss. You'll only be preserving wealth, but not wealth because you might sell at a loss. While in stocks, you grow your wealth. So it's you to make that decision. Are you preserving money? But remember, right now, gold people are buying out of hype and sentiment. When that hype ends, price will slam down very quickly and very fast. Will you be losing? So I don't want to go to that recommendation because I usually don't recommend on Absa Gold. For those who have tried to get a recommendation from me, you know I always tell you, Absa Gold, unless you're parking your money without any returns, don't try. Because unless you're checking the market, then you check when there is no supply and you put at the highest price and you leave it there. You make that difference. But again, 1 unit is 5,000. Owning 100 units, you need 500,000. Would you invest in a dividend stock or in gold? It's just a question you need to ask yourself. It's money you're parking somewhere. What gains do you want? Do you want this 500 to grow to millions, or do you want this 500 to stay there? Then you might sell at 300,000 because the price may go down. It's all about investor decision. So to check the prices, when you log into the portal, there is that screen we call market depth. I will do this on Wednesday because market is closed today. We can't see those. Look for GLD, click on it. There is a screen called market depth, even on the portal. It is split into two. You think grayish and pink. One side is bids, the other side is offer. If you're buying, always look at the offer side. Go to the online portal, it has splits. Check how many people are placing those orders. If you see just 1, 1, 1, and the other side 1, 1, 1, don't even buy. Because that is one order that is placed there. Maybe it is one person who have split his order into those small orders. Just as again, as I said, spoofing the market. You still think these are many people, you go and start selling or buying. But he's taking advantage of it. But if you already bought ABSA, now try to play with the market. When prices start to go up, place at the highest price and see if you can gain something. So if you get into the market, anytime you go to the market and you find on one side they have large orders, but if you look at the splits, it tells you these are few sellers or few. You look at so the way it works on the portal, it has offer quantity, offer price, split. Then there's bid price, bid quantity, then split. On the app, it is not there. The splits are not there. But you can tell with the number of shares. If you find the buy side, if you have to do total, you find it is more than the seller side. There is a possibility of prices going up. And the inverse is the same. If there are more sellers than the buyers, they'll push the prices down. So if you want to buy ABSA Gold, because it is you to make that decision, always check. If there are more buyers than sellers, don't buy that time, because they will push prices up. Then when will you sell? If there are many sellers, it means prices are going down. They go down. Wait for that time, buy. When it goes up, but it is a risk you are taking, because there are no dividends. Even Satrix ETF, it's not giving dividend. Don't be right by anyone. The ETF provider who in the international market is actually, is it BlackRock? Who then they work through the ETF provider in South Africa, then Sanlam in Kenya. Their cost they incurring, they need to make profit. So the dividends they get, that's what they use for covering their expenses and also management fee. That's why most of ETFs don't pay. Those ETFs that pay dividend are in international markets, not in local market. So as I said, for NSE GLD, first of all, it has low trading volume, very low liquidity. You might be stuck with it, but again, prices means moves because of demand and supply, and it's because of that widespread and also not many people buying and selling. They only look for opportunity. Somebody will put, when it is the highest buy side is 5,000. Somebody will try to spoof by putting 8,000. They know there is that difference of 3,000, and the market allows you the highest. They know there is somebody will place a buy order for market. There is a likelihood they will hit them and they take that profit. We are coming to spoofing because it's one of market malpractice that is ideally allowed by NSE, but if you are caught, then you might face the consequences. So for GLD, don't think of it as a short-term trading, because prices may not move that much. You need to play around with the market. There is no ownership here. It's just gold exposure. But remember, even if you're telling people you're owning gold, it's your money you have put in. Is it making money for you? No dividend, no boards, no right, voting rights like shares. You're not entitled to anything, only price movement. It's only for stability, but not for growth or income. There are risks, high risks. And this comes to reading market depth and market orders. As you can see, there is spoofing somewhere. I've done a full video again. I won't go into details for market depth in details. It's there on my channel. It's a full video, 2 hours. So it can tell you about market depth, what you can do and what you cannot do with it. Market depth, you also hear the people calling it order book. It contains all pending orders on buy side, bid, and sell side that have not executed, ask side. Execution will only happen if a bid and ask order matches. So when you see there is a lot of buy orders with high prices, that is at the top queue of the buy side, that's why you have most of the orders. The others maybe are in small quantity. It may signal bullish sentiment, which means what? Prices may start pushing up because people are willing to buy. However, if you find the big orders are at the bottom, not at the top, that is what we call spoofing. I'm coming to that. It's people placing fake orders. Just to show you there is that demand, but those orders cannot execute because they are at the bottom. They're just to speculate the market. So at the top queue, if you find there are big orders, then there is a possibility of bullish market. And prices may go up. On the sell side, it's the same thing. Large orders at the top, it is the settings pressure. It's called bearish signal. Prices may go down. But if the sell order at the highest prices at the bottom, then that's somebody spoofing the market. It is allowed, as I said, it is an order you're placing. As long as you're not placing and canceling, because then that is market manipulation. So you may need to watch during the day how those orders change, because if prices keeps on increasing and the orders, again, quantity also increases with the price movement, then there's a likelihood the market will go up. The same thing with the sell side. But for spoofing, if you find there was orders at the bottom, then all of a sudden they have disappeared. That's somebody who spoofed the market and they got what they wanted. How? We are coming to that. Yes, they put a buy order at the lowest, then they removed. You may think they bought. No, they were trying to sell at the highest price. Just try to show people there is demand. You come in, you want to buy, then he places a counter sale order at a higher price. He will hit you. So spotting hidden orders used to manipulate prices. This is what is called spoofing. Sometimes traders and even institutional trades, they may do these. They place large visible orders because in the market, let me maybe give you another secret. In the market, you can either place an order yourself or a dealer from the broker places directly to NSE platform. Remember, you are placing to broker platform, which submits to NSE. So you don't have control over some of the parameters. Trade have additional parameters. One of them is disclosed quantity. You will not see it in your side. Disclosed quantity says, I want to place an order for 10 million shares, but only show the market 10,000. So you on your side, you see 10,000, but the person who has placed that order, it's not 10,000, it's 10 million. You will never see those orders. If you see 1 million shares on your side, that's somebody playing with the market or somebody who doesn't know how the market works. And it is unlikely because even the broker will call that person immediately to even understand what they are trying to do. So basically, when you look at the market depth and you realize there are some orders which cannot be supported, like 1 million shares at a lowest price, that's somebody trying to spoof. They are trying to fake demand or supply. So that will push prices up. So even if you say 10,000, that does not mean that's what is in the market. It may be 10,000, but using this closed quantity, they are showing that 10,000, but the order quantity is of 1 million, just for market protection. So spoofing is where you place large visible orders, but to influence market perception. Then it can be cancelled even immediately. Once I'll tell you how they manage to execute their trade and get what they wanted. So that one they can cancel. If you see it's not cancelled, that's somebody who is intentionally pushing prices towards their direction. So spoofing is where you create fake demand or supply with large visible orders, but they are put at prices lowest price in the queue where people know it won't execute. Even if it executes, they'll execute a small amount so that NSE doesn't get to know they are spoofing the market. So then how do you detect these? First of all, check whether there is consistency over time. If you saw there is 1 million demand, just wait for like 5 or 10 minutes or 2 hours, see whether that order will go. If it goes, you may know that that's somebody who have already gotten what they wanted in the market. If it is still there and prices are moving up and it is not moving, then that is somebody who is intentionally doing it to push market. Also compare order sizes with splits. That's why online portal is very important. I'll log in briefly to show you that. So you find it's, let's say, 1,002,000 shares. Then you find split is 2. It means those are 2 orders. Somebody plays 1 million and another one 2,000. Why would one person place just 1 million orders and they can see it's only 1 order for 2,000? That's somebody who's trying to spoof the market. Then always verify price movement and also executions with the actual executions. You can always see that on portal. Not the orders that we're just seeing on the order book, which is also market type. Let me go to the one link that I created yesterday. I show you because now market is closed, we won't be able to see that. But within that link, I've tried to simulate that. Then we log into the portal. I show you now where to look for these. So let me just open. So that now we go to Q&A. Let me just open the spoofing. Then let me log into the portal. But even on the app, you can be able to tell based on the number of shares that are there. So I'm just opening the 2 links. One is a blog post which has the simulation. Let me share that link on the chat so that we can follow together. That is the link for spoofing. Let me share screen. Then I'll just, because this is the last one, then we go to Q&A. So for spoofing, if you scroll down on the link I've shared, there is that market depth simulating Safaricom. It simulates what is on the portal. You have the bid, price bid quantity split, but I've disorganized it so that you don't think this is the trading. If you look at the bid side at 1510, there is 1,200, but the splits are just 3. What does that tell you? There's somebody who have put a very huge trade just to show there is demand. If you look at the ask side, there is no huge orders, even on bid side. So it tells you the person who have placed this 1 million is trying to spoof the market, either to show there is demand, push prices up, because you push the prices up. You will cancel this order for 1 million because it will be hidden now from the prices which are visible. You will cancel, then place a counter sale now at a higher price and make those gains. So he'll push the market up because you start coming and start buying 1440, you clear 1445, 1450, because you still want to buy because there's somebody who have placed the order for 1 million. Then he'll come and place his counter sale trade, let's say of 50,000 or 100,000 shares at 1550. He have made his gain. The other scenario is where he wants to create a fake demand. Then the sellers think there is existing demand for shares. So they will try to sell even at lower prices, thinking prices will go up. He will remove this 1 million, then put at a lower price the shares that he wanted to buy, let's say 100,000, and he will hit the market. As I said, traders platform is not connected to CDSE and broker platform. You're able to put some of these orders. On your side, you may not be able to do that unless the broker have given you that leeway, or you have cash or shares. So on the sell side, it's the same thing. You find there's somebody who's trying to sell at a high many number of shares, but at the highest price, not at the lowest selling price, at the highest. He's trying to create an illusion that there is supply. Then you, as the people who want to buy, you continue buying, push prices up, push the prices up. Then you put his order at the highest price and execute. Or the other way around, where he's trying to create, there is an illusion of supply. Then demand will withhold shares, push prices down, then he will buy at the lowest price. It is not allowed by NSE, but it's not easy to detect. It is one of the worst stock market malpractice, but apparently it is allowed by locals. If you place an order that is a genuine order, it is you who knows the intentions. So if you go to online portal, you'll be able to detect. If you click like APSA, it's only that it doesn't show. There is this screen that is split into two. You can always tell because now they'll be arrayed. So you look at the splits and bid quantity, price, and the prices. Then you also need on the screen, on the watch list, if you scroll on the right, you can see the turnover and the volume. You can relate that. If turnover and volume is low, then there's somebody who is placing an order of 1 million. That's somebody playing with the market. But if you find the turnover is above 1 million, then it means there are people who are trading on that share. But remember again, as I said, institutional traders and big investors, they use something called disclosed quantity when place the order. If they say we can only show, let's say 1,000 shares, but our order is 1 million, you on your side, you see 1,000. You think there is no supply, but there is an order hidden. Those are the ones which are called hidden orders. And you can always tell through volume and turnover, and also foreigners buy and foreigner sales. Because if those figures are high, then something is off. So that is on spoofing. I hope on Wednesday, because today market is closed, I may not be able to show you. Wednesday, I can show you practically now when market opens. And hopefully that day we'll be able to detect those, as long as you don't report that to say, you know, I'm the one to give that client. Anyway, let's continue. Let's see. So just go, I think these are, it's only 2 slides, then we go to Q&A. So as I said, there is a bid-ask spread. The top bid, top ask, the difference between the two is called the spread. So immediately you understand bid-ask spread and also volume strength. That is from the portal I've shown you where to look for it. You'll be able now to tell when people are spoofing or playing with the market. Bid is the highest price the buyer are willing to buy, to buy shares. And ask, the top price, is the lowest price the sellers are willing to accept. So the difference between the two, the top bid and top ask, is called spread. That is the difference. It will show you market liquidity. If the spread, that difference is less, then market is liquid. You can be able to buy and sell quickly without incurring high cost. Wide spreads means low liquidity and uncertainty. Then high volumes on both sides will suggest active trading interest, but as long as it is not at the lowest prices. If there is low volume, then caution and quiet market, especially for the active stocks. I think for the rest, post-dividend and post-resort strategy, how you can position yourself. After book closure, Remember, new investors are not entitled to dividend, so prices go down. That is the time to buy because market is at its lowest before prices readjust. Even after results, I said this is during results day, it is open day. You also need to check if the company announced good profit. If they announced a loss, you expect prices to go down. That could be the time now you want to get in. If it is profit, you expect the prices to go up by that same day. So then when do you take profit? When prices rise up significantly, but there is weak fundamentals and weak buying volumes. That is the total quantity you find is low. Then dividend yield is small compared to the price movement. It means prices were moved by hype. That time take your profit, move. Then when do you accumulate? When prices drop more than the dividend amount value. But company fundamentals are strong. Remember, we said don't buy with technicals, buy with fundamentals. Then if a company have issued, let's say, after dividend, they have issued a bonus or results are coming. You expect the same prices to fall. That's not the time to sell. As a caution, avoid rallies, especially social media hypes, and use the headlines. Most of them, they are paid by top investors just to gain from the market. They could be temporary, which may result in you making losses. With that, I think building NSE stock list. I'm not sure whether I'm sharing the same screen. Let me stop sharing. I just briefly show you how to build your watch lists, but we'll do this practically again on Wednesday. This is a watch list that is default in the platform. You can always create your own by removing what you don't want. By clicking here, you just remove. If you don't want that, it will be removed. So you can remove, then you can rename this watch list. If you go to the plus, not duplicate. Let me stop. You need highlighted and try to move across. There is this icon that looks like gear. If you click on it, it has a layout with a default. This is your default watch list. You can always create new watch list. I think I may need to refresh this. So gear. You can always rename watch list. I'm not sure why it's not working here. On the app, you're able to create several watch lists, but on the portal, you can just remove what you don't want. Once you remove, that becomes your own watch list. Now actually it is here on top, default dashboard. You can create dashboards on the portal. On the app, you can create watch list. So you can rename these maybe to something else and even delete. So you can create another one, maybe this, you can call it bank stocks. You can rename these maybe banking stocks. And maybe dividend stocks, because you don't want to track maybe all stocks. Then you click save. So you have these. You can add now widgets. Widgets, like if you don't have any, or any screen is missing on your dashboard, you can come and add. So you only need the market watch and market depth for now, but you can add the others. They are added. Now within this, you can come now and select banks. Yeah, ABSA and maybe other bank. I don't want to go into details. Once you select, you click add, it will just add. Now you can be able to track. If you want to move, you can just move with the buttons. So you can move with the buttons to the watch list that you want. That's how you create your own watch list. We'll go through this on Wednesday. So let me go back to the presentation. We go now to Q&A. So I want to go to the first screen so that for those who may want to reach out to me, that's my WhatsApp number, 0723384775. Reach out anytime. We go to Q&A quickly. Then we can call it a day. And hopefully you have learned something. If you have any question now, put on the chat. I'll share the recording. Let me just pick that playlist quickly. I will share it on that. This WhatsApp. This YouTube channel. I'm just getting that link because I don't want you to follow everything on that channel. I'm just picking that playlist. Then we go to Q&A. It's a podcast. Yeah. So it will be posted on that playlist for that YouTube channel. Let me see if there is also the WhatsApp channel. Though these days I'm not posting a lot on WhatsApp channel, I'm on community, WhatsApp community. So we go quickly through the Q&A. And I hope now you have seen how spoofing works. It may move either prices in favor of that person who is placing the order, or they are targeting for the prices on the different. If they place the spoofing order on bid side, they are targeting the ask side to sell at a high price. So they will imitate demand, push prices up, but place now the genuine order to sell at a high price. Or they're trying to entice supply that there is demand, push prices down, cancel the 1 million, then buy with the right number of shares. Maybe even above that figure. So may show us a sample how it is and how many spots spoofing is. This we can do on Wednesday. That time market will be open. Recording, I will do that. I will share on that WhatsApp channel. I will share on WhatsApp channel, WhatsApp community, Telegram channel, the Telegram group, the link now from that YouTube channel. But if you can subscribe to that channel, that's it. You get notification. Yes, KPLC and Kenyan shares have increased over 200%. Very curious compared to last year. They are trading below 3 bob. Okay, for KPLC and Kenyan, first of all is the results that they announced, but there are also some internal politics which you may not want to get into. You just watch the prices the way they are right now, then you can make a decision whether to continue buying. Right now it's come dividend. So if you see some price fluctuation, know even that price movement was not supported. If statement presented are misrepresented, how do you then get correct financial position of a company? Just go to their website, download the full booklet. It has the details. You'll be able to spot these differences. Some companies are undervalued. Why is it so? What is the impact? Undervalued means the price they are trading with at NSE, it's not their correct price. It should be trading above that price. But again, this is a market at NSE. Even if they are undervalued, price movement is limited. So non-current assets, I think that is answered. Assets that you cannot easily liquidate. That is, you cannot easily sell. Does it mean lower PE ratio the better? Remember, ratios don't show you the fundamentals. Even if PE ratios are low, you need also to check fundamentals. Fundamentals are playing a very great role because they're the ones that determine company performance and the true picture of the company. Slides, I will share that. Slides, I will share. Excel templates, that one I will share that. Let me see. I'm not sure whether research will be able to share theirs, but it's something we can I can create for you. How important is book value per share when you want to know which share to buy? Because book value per share, if we go back, I think there's somewhere we may have covered it. Let me see that slide. For PE ratio, I think PE ratio, it's not the lower the better, it is the higher the better. But again, it may mean overvalued. The lower it is undervalued. That means a lower PE you can buy. That is the time to buy. If it is higher, then it means it is overvalued. You can sell. But again, remember, for us, we are building wealth. We are not selling. Book value, it's not here. I don't think we covered book value per share, but we'll do it next time so that we know how important it is. Actually, next week I'll try and add more ratios so that you understand how they work. What do I think of KPLC? Anas? Okay, KPLC is for speculation because of the huge price spark until maybe in the next few years you see how prices will be, and also dividend. For now, just treat it as a speculative stock for dividend. For Kenya Pipeline Company IPO, it was already approved by Parliament. Brokers have already tendered their intention to participate in. Hopefully, we get a lead stockbroker and sponsoring brokers. Once that is done, it's just now the tentative date for the launch. Hopefully, it can be done this year. Everything will just move swiftly because this is a government entity. And I think we did this last time, and we related this with KPLC. Yeah? KPLC prices may be spoofed just for Kenya Pipeline IPO, just to show you government entities are making profit so that you are enticed to buy into Kenya Pipeline IPO. Hopefully, after that, we don't see prices go down. And I think Honorable Nyoro may have hinted what may happen next year. You may buy and prices come down. If that happens, we may expect even KPLC may also be affected. And then scorings, I think this is something I always try to avoid. KPLC mostly is a politically run company. So even their prices, they may be. In terms of deadline, I don't think it's confirmed because prospectus is not out. Wait for the prospectus. It will have all the details. All companies are required to give detailed report. If you go to their website, just go to their website. Any company that you're looking to get full financial results, just go to their website. Even NSE websites, they could have uploaded the full results. but mostly in their website because they are required. Even brokers, we are required to do that. We go quickly. What is happening with Williamson T shares? It is going down too much because of bonus shares. You know, book closure was on 13th. Between 13th and is it 17th? It was the time they were loading, but yesterday was a public holiday. So, because the prices had to readjust down with the same price. It's the same with dividend. It's called bonus dilution. You are given extra shares, 1 for 1. That means price had to go down by half. But again, investors are also willing to take profit by selling the shares that they receive as bonus. So then they want to sell what they have, then they use the bonus to replace. So that excessive sale is pushing the prices down. But again, spoofing, something you also need to check. Apparently, most of the stocks in NSE, you may find there is somebody who is spoofing that stock just to make gains. Push prices down, buy at a low price. But hopefully that's not what is happening. On Tuesday, just try to look at its order book and see what is happening, because this is not a stock you find most people selling. It is usually held by people in retirement who are looking to get money through dividends. So for those who are selling it, possibly those who bought for speculation, they want to take profits. But again, bonus shares have not been loaded. So it could be just hype in the market. Does open day apply for all shares or for ex-dividend shares? Open day is for any share that have declared dividend. So open day will be on ex-dividend date. Bonus, again, ex-bonus date. Split, ex-split date. Then there is announcements, company results. When they are releasing that day, it's open day, or when a company is announcing profit warning. So that day there is no limit. It's only the upper limit to the highest, but you can place any other price in between. Where can we see market depth? On the app, just go to the watch list menu. You tap on the share you want to see. The next screen with now the split. On the portal, when you click on the share, there is that screen that is split into two. If it's not there, you just click the plus sign, add it. But on Wednesday, when market is open, I will be able to go into details. How does one check the splits when orders are made? On the app, it is not there. On the portal, on the market depth, there is an additional column for split. It gives the number of orders that make up that quantity. If quantity is higher and number of orders is low, then that is somebody is spoofing the market. However, if it is higher, now with one share, you expect that number to be up. If it is up, then chances of spoofing are low. Maybe it is people who have placed the disclosed quantity orders. That's why you find in the market, you find they are reporting maybe 1 million shares traded, but you didn't see them. It's because of disclosed quantity. They only disclose a few number of shares, but execute in full lot. Why? Because fund manager would want to execute 1 million with another 1 million. So they disclose that to show the others there is that liquidity. But brokers know themselves. They call the other broker to confirm whether they have shares. So you, when you see 10,000, you panic, you don't want to buy or sell. So you have given them that spread within the top price to execute that 1 million by themselves. But again, that is not market malpractice. It is the system that allows. If I buy shares on that year, when will they be settled? T plus 3, T is trade day plus 3 working days, because that is CDSE and it is by regulation. When will they reflect on company book records to be eligible to receive dividend? Okay, now when you buy, what happens? The person who have sold to you, immediately they lose those shares. They are credited to your account, and you lose your money, they are paid. It is credited, but they will be paid on the fourth day. So the shares reflect the same day. So even if you buy on book closure, you own the shares. You are the new shareholder. You are the one who is entitled to that dividend. So as long as you're in the register on book closure, you're entitled to dividend. After that, you can decide what to do with the shares without any risk. I've shared the link to YouTube channel. Isn't capital gains a multiplier that can lead to wealth growth if money is smartly reinvested back? It all depends. You can, as long as you're not withdrawing. But again, there are costs you are paying. If you bought a stock at a lower price, I would advise you don't sell. Unless you want to take profit, but don't withdraw, reinvest again to use that amount to grow your investment. But remember, dividend is free money you are getting. YouTube channel, I've shared that link. Where can I get the compiled list of companies with large dividends? I'm happy to share that. I'm compiling list of dividends that have been paid previously. I'll be sharing that. Just join that WhatsApp community. I'll be sharing there as we run. Videos, they're in the WhatsApp on the YouTube channel. Cynthia, I've shared the link. Thank you, Cynthia. Is that the reason why share prices often go down soon after IPOs? I hope you are talking about dividend, after dividend. If it is after IPO, again, it is a market demand and supply. And it means that company, when it was listing, it was not supported by fundamentals. It is technical analysis which was done. PE ratio told you it's a good company to invest in. Where again, in real sense, that company is not growing anything. I don't want to downplay the Kenya Pipeline IPO, but wait for prospectors. But the president said what they are trying to invest to do, to pay debts. Meaning fundamentals are not supported. So even the Dinyoro proclamation, the price will go down, is already confirmed. Well, if they are using that amount to pay debts, then there is no investment. There is no return on investment to you. What do you expect to happen on NCBA Stanbic shares on the ongoing talks about acquisition negotiation? Should someone buy or sit down and watch direction the market will take? Again, there are two things: investor sentiment and what is on the ground. What is on the ground was clarified. It is just a proposal, nothing has been agreed on. CMA and NSE clarified that that information was not supposed to be posted because it caused panic. For NCBA and Stanbic, their shares are strong. If you look at their dividend, Stanbic, they give a good dividend. When they merge, what will happen? It is Stanbic that is buying NCBA. So NCBA shares will be converted to Stanbic at their price. But again, remember, the shareholders of NCBA, they are not entitled to that price shoot up. You may find they will try to balance that. Because again, it will create panic. Because it means NCBA shareholders will have an advantage over Stanbic shareholders. NCBA. Let's go to the other question. As a long-term investor, because that tells you what is happening in the market, somebody could be, again, spicing the market to favor NCBA, price goes up, sell at a profit, get out. Then you find it's fake news. That's why I ask who owns NCBA. As a long-term investor, there might come a time when prices have gone up such that you have made good capital gains. Is it advisable to sell part? You can even sell everything, but don't withdraw. Buy another stock that is wrong. But as long as it's a counter that is, as long as it is not a counter that is giving you dividend. Was getting back to that share, price may take a while before it goes down. Is it advisable to target both capital gains and dividend for long-term growth? Yes. You can buy share for dividend, but when prices go above and you find you're in profit, sell, then buy another dividend stock. Wait for that to go down. Then the dividend you're getting from the new stock, you can buy back. It's all about how you play it. But remember, cost. As political temperatures are likely to rise up soon, and from the onset, we are likely to see shift from wheelbarrows to motorbikes as a chief campaign tool. What's your take on car and general stock from now to 2027? It may depend. This could be maybe something that you may see on social media, people discussing, but that may push prices of car in general up. But I don't think this will happen. And I think there will be a shift even in political temperature. We have seen the big wings coming together. And with passing of the late former prime minister, I think he's the one who used to move the politics. I don't see anyone who can fit in his shoes. I don't see. I can't see. Unless the former president, and I don't think constitution may allow him unless he's using another person. We may see political temperature change. Maybe we see, you remember the time the late President Moi was passing over to late President Kibaki. There was that time we had a very good political temperature. We may see the same thing this time. I don't see anyone who can, unless there's something I'm not seeing in politics, this time it might be different. Things may play, but we'll know once what is happening today and tomorrow passes. Maybe from next week you start seeing some changes. And by the end of this year, we can tell about the political temperature. And again, politicians who talk out there, most of them, they don't own shares directly. They own indirectly. So they may not know the effect of politics on stocks. Most of them, they buy using custodial accounts where they are not disclosed. You never know whether they own shares or not. Tony Didignoro disclosed that, and because people know it, it's already in public domain. Honorable Ishungwa and Mwaura, it's because they were exposed. Otherwise, that transaction would have gone through. And even the brokers would not have known it is them, apart from the trader who is doing it. Because they usually use custodial accounts. Nominee accounts, where the underlying beneficiary is not disclosed to the public. Other than KPLC, which other share is hyped? For now, Williamson, Kapchorwa, because of dividend. Even NCBA, I don't trust its price. But most of stocks, because of the results which are announced, their prices have gone up. Hopefully, with Q3 results coming in late this month or in November, we won't see a shift in price. Consider taking on, okay, rates. I think that's something I can talk about. Spoofing I've talked about. What is the investment horizon when trading Absa Gold don't put a lot of money there. I would advise don't even put money there until you know how the prices move. As I said, it was only one order that pushed that price to 8,000. And it was reported, yet it is just one person, and maybe they didn't know what they were doing. That a new ETF introduced that have international stocks, but it is a feeder ETF. Feeder ETF for international stocks. It doesn't give dividend. You can only make money through capital gains. I didn't want to talk about this. I wanted to talk about it on Monday when I'm trading international stocks. Hopefully, I'll be able to schedule that. ETFs, unless you are looking at price movements, there is no other way you can make money. ETFs only price movement, capital growth, unless ETF is giving dividend, and it's only in international markets, and I think it's only a few. The others you can only make money through capital gains. Most of that, the profit they make is reinvested back, so they don't give dividends. Even if people tell you ETFs, they are good, they are only good because they have security. Price cannot fluctuate that a lot, like shares. But that means even in gains, you can't gain a lot compared to shares. Individual stocks, they have potential for capital gains, but also potential for huge capital loss if you sell. But ETFs, you're protected, but in terms of gain, unless you're looking at a longer timeline, horizon. Which other ETF can we use to trade global shares in S&P 500, Jones, NASDAQ, ETC? Which ETF can we use to trade globally directly apart from the one listed in NSE? Unless we are going to do a look who have international stock trading or TIB, S&P 500, there are two VOO and SPY. They track US tech stocks 500, top 500. Then we have at the NASDAQ, we have QQQ for NASDAQ listed stocks, tech stocks. Then we have, there are many ETFs. It all depends on what you're looking for and whether that ETF gives returns to you. But as I have said, ETFs, unless you are holding for long term, they are only good for stability. Remember the stocks inside, even if one goes down with a huge percent, one may appreciate at a huge percent. So it will average up, which is different from buying individual stock where you'll be hit directly. That is the only advantage of ETF, where you don't lose with a huge margin. But again, you can't gain with a huge margin. Remember, there are also other stocks within the ETF which are limiting the prices. But I'm not discouraging you. Let's meet Monday for international stock trading. It's only that tomorrow I'm not able to train, and I've done that. Most people are in charge. So is it a buy or keep of Absa Gold? If you have not bought, just go to another stock that is giving you dividend. Don't be quick to get in. Price is high. You need a lot of units to make money. And as I have said, the price movement you're seeing these days with Absa Gold, it's those people who are new, who don't know what it is. They want to buy because the NSE said you can buy one share. You put your 5,000 there. If it goes back to 3,000, it will stay forever there before price goes up. And they are not dividends. Is the world economy headed to recession or where it is? This I may not know. Maybe we can cover this in international markets, but we saw what happened with the US government. There was a time they had shut down some departments. Hopefully that's not where we are going. And you can always tell that with the interest rates, where they are headed. And also our markets. If you see on portal, foreign buys, they are more than foreign sales. It means foreigners are coming in. There's something wrong with the international market. If you see foreign sales are more than foreign buys, then foreigners are getting out. It means something is good in the international market. When the market shows an equal number of buy and sell orders, what does it mean? Should investor buy, sell, or hold? In terms of buy, it is fundamentals. Is that company strong? So buying, you look fundamental and a bit of technical analysis. Selling depends on your portfolio valuation. Even if an analyst puts in bold and even increases the font, sell, don't sell, go to portfolio valuation. It's your money, check whether you have made money. They could be selling you sell, yet you have not made profit, your own loss. For a hold, you look at your long-term decision. Are you buying for wealth growth? If it is that, just hold. If you, however, you are short-term trader, when there is more demand than supply, that is time, to think of buying, because prices will go up. If there is more supply than demand, it's time to sell if you're taking profit. If they are equal, then that you hold. That's why I've started with long term, then short term. Short term, I usually don't advise because you can lose money. Channel, I think it's already shared. How is spoofing possible yet? It is a broker who execute the buy or selling. Are there individuals who can execute without using? Yes, you're using broker. Even broker, you have their own platform. You are placing order at NSE. It is a genuine order, but you have placed 1 million shares at the lowest price. Why? You are putting a selling order at the highest price. Why? It means you have intentions to do the counter opposite or push prices, then you remove. NSE, as I said, they can't detect this. They have tried. They will come to broker and ask, why are you putting orders then cancel? Broker will tell them it is client's intention. They press, then realize the market is going up. They withdraw. So then it's very hard. It's very hard for NSE and even CMA to track these. That's why I thought of bringing it up. You don't become a victim of it because it cannot be controlled. Unless CMA and NSE say you should not cancel your order, but then why place an order if you can't cancel? Where do I check market trades and volume so that I'm able to know whether the share has really been trading or it is spoofing? On the online portal, you saw where I went to the plus sign on the top right bottom, you can add sector statistics. And also there could be other screens. You can see the trading. Also on the watch list, you can scroll to the right or even go to the settings, add the screens that are not, columns that are not there. You can use those. You can easily tell. Let's meet on Wednesday. Wednesday, we do spoofing. And please, this information, let it stick around us. Don't circulate it on social media. Otherwise, you may become a target for the market players. Because you'll be exposing some of these traders use. Are genuine traders safe when then with spoofing? Actually, you should not be worried about spoofing. It may work for you. If you see a big order, you see prices going down, that's time for you to buy, but not time to sell. So only where it affects you directly, that's when you need to be worried. But you need to identify this because when somebody is spoofing for his intention, you can use his intention to your advantage. What's your take on Kenya Lee in terms of fundamentals? Because there is a social media hype for this counter, and it's really tempting. However, from your training today, I have also considered the fundamentals. I think there is something I saw on Kenya Lee where they will be taking some of insurance services from the government. But is it one entity or one time thing? That's why that is spiking the prices. Because government have identified them. But my question is, how long? It may be good for short term. Maybe they will start if they say, as an insurance company, what they want to meaning eating to their profit. Dividend may slow or you may not find any data. Difference between volume and turnover. Volume is total number of shares bought. Turnover is the total volume times the average price. So the turnover is like the total amount that have been moved in the market in terms of cash, because that is volume. That is the number of shares times price. Volume is just the total number of shares. How do they relate and how may I use them to spot spoofing? If you, okay, volume times price. they may not, both of them may not show you, but volume can tell. The number of shares moved. Even turnover, no, because it's times the price. Yeah, you can tell even through turnover, because if you find the volume is high, but turnover is low, it means somebody pushed the prices down. And most of the trades happened at the lower price. So spoof the market to push prices down, execute a huge trade. If on the other side, volume is low and turnover is very high, then it means somebody was spoofing to sell at a high price. So there are other low prices, but we're targeting at a higher price. So they placed an order to trigger prices to go up. You can always tell from all those. But again, look at the number of trades that you can tell. But mostly you can tell it from order, market depth or order book. You can tell. Hopefully on Wednesday, we'll be able to get an uncertain order that time. Because they usually appear then disappear. How many order splits into small units? How many have my order split into small units, e.g. place an order of that, but broker splits at 140, 130, 10. This is what I was talking when I trained on one share trading. Just look for that video. It is the worst thing that happened in the market. When you place a 200 order, there is no way you can limit that the person buying to you from you or selling to you should take that exact quantity. There is no way. So if one person is buying one share, that's what you get. Another one comes 10, that's what you get. Another 20, that's what will happen. The issue is on one share trading. There is no way you can combine all of them. It's an NSE to find a way to resolve that because brokers can't do it. It's actually happening at NSE level and CDSE. We rely on reports from the two. If they change their platform, that will be changed on our side, but we can't touch because every transaction in CDSE settles individually. The problem is one share trading. The problem is actually not you, the 200. There are people who are placing an order of 1 million, but they are being hit with those small trades, so many of them. As a broker, you have to think of how to give a combined report, which is crazy. Hopefully, NSE will realize that and they change. I'm now less enthusiastic about stock trading than ever. Don't even never be worried about stock market. As long as you have information, everything is simple. How can you remove stocks from our watch list on the app? Just go to the name of the watch list on the app on top, where there is my watch list one. Press your finger and wrong press. Don't release. It will bring a pop-up now where you can click on the icons to delete. I will share the slides. Don't worry. I will share. What is your take, Kenyari? I think this one I've said. How does Sterling Capital provide liquidity for derivatives in the Kenya? They are using their own assets. Their own balance sheet is what they are attaching. Yeah? So they have to look for money, give that money to MSC to do it. Initially, it was AIB. Then we stopped. There is money they have given to NSE to use it for liquidity. At how do they make money? Through your trading activity, because they're the ones who are offering trading right now. But there could also be some interest they are getting, but that is not guaranteed. But it is positioning them in the market as the only derivative provider. That's why AIB stopped offering, because you are not making money. Can spoofing be considered as smart investing with genius intentions? Yes, as long as you don't play it for some time, because eventually you'll be caught. If I buy shares now, am I entitled to earn dividend? Maybe for Kenya Power, because they are still in dividend, but don't sell up to and including 2nd December. I think that's when book closure is. Meet me on Wednesday, then we can discuss on this. On foreigner side, does it mean it's time to take profit for growth stocks? As many foreigners are selling, what actually happens in foreigners sell or buy on price of shares when foreigners buy and sell in large numbers? First of all, when foreigners are moving, they are taking profit, and not just taking profit. They could be selling at a loss at NSE, but gaining through exchange rate. So never follow them. Look at fundamentals. Have the company maybe reached at its highest? Maybe that time you say they're taking profit. Then go to your portfolio valuation. If you made profit, take. But if you notice they are selling and exchange rate has gone up, US against Kenya shilling, don't be tempted to sell. Them, they are not targeting to make money with NSE. It is through exchange gains. So never follow foreigners. Always use them as a guide. The only team that you can follow is institutional traders. With them, they are genuine. They are not taking money outside. Can one person split in the market more than 3 times for spoofing? Yes. You can place as many orders as you can, as long as you have those shares or you have that amount. The market doesn't limit you. So you can use one order for spoofing, but you have other orders, genuine orders now to target the market. And as I said, this mostly is done by traders, because for spoofing, it involves large orders. Unless you have huge amount in your account or many shares, you can't be able to do it yourself. And for traders, it is market malpractice. How can I analyze the market so that I buy at raw and hold for a decade or more and pay me a good price? Just look at market cycles. Like now we are going to elections. There is a anticipation prices will go down. If they go down, you can buy. We are going to Q3 results announcements. Those that will announce losses, expect prices to go down. Those announcing profits, announce prices to go up. I expect prices to go up. Time open days. Those are the best times to buy. But any other day, you can be buying small lots. When you do dollar cost averaging. Take on ABR, they had an update on redemption. Is it a sign they are doing good? That's on board, corporate board. Doesn't affect NSE markets. That is their corporate board. It's on board market. It's not on shares. How is NSE company stock? Is it a good buy for long term? NSE, I may not comment on this because it also has its own politics through brokers. And you have not seen price movements and also price gains. I have not seen their financial results yet. Are you recommending stock picking by individual or to invest in available CIS fund instead of to grow wealth for long term? If you're I've not understood your question, but maybe if you're looking at wealth growth, you can do stock picks yourself based on recommendations that may be there, or you do your own analysis. If you're looking at funds, ETFs, unless you're looking at stability, where maybe you expect some stocks will be affected, then you want stability. As I've said, ETFs, they don't offer that much growth compared to individual stocks. They are only good for security. Why are prices of NCBA shooting? I think these are answered. It's because of that hype. And people know Stanbic is the one which would acquire NCBA. So it's only fair you buy NCBA shares. But again, it was speculation. What are your thoughts on real estate share, Home Africa? Home Africa just got to another stock. That one I can't tell you to buy now. Even if there is a future demand for housing, through affordable housing, that project could only go to housing finance. I don't think they can give it to Home Africa. Explain what it means, update of NSE. This one I've not read. I actually I saw it today in the morning, but I don't think it has any effect. NSE, they are trying to spice the market, make their share look profitable, but it's just a recognition for NSE. It doesn't have anything else. Prospectus for IPO, once everything is in place, it will be released. Sanchanted owns Stanbic. I thought Stanbic is owned by Standard Bank. Oh, sorry. But what is the difference between the two banks, Standard Bank and Standard Chartered Bank? I may want to know that difference. Maybe I may have said it wrong. It should be Standard Bank, Stanbic. But again, for NCBA, I would advise you trade carefully. Can Stanchart share gain as a result of buyout? All stocks are independent. Even if Stanbic buys NCBA, if they don't do full merger, they still be trading as two separate entities. I don't know whether, where was I? I think I'm about to finish. Percentage of foreign shareholders at NSE. I may not have that data right now, but you know, for foreigners, they don't trade for long term. They buy and sell. On the open day, when KPLC announced dividend, people were placing orders at raw price. Yet on my side, I was limited not to place less than that. Does it mean that some people are limited by certain price, yet it was well indicated that the market is open? It is a system issue during migration, but that is being resolved. If you notice, you could put the price, but at the point of submission, that's when the system gives you a crazy error. That's a system issue. You should not be limited. The ones who are able to price went through back office system. That is the NSE trading system. What are your thoughts on equity funds such as Avocap, Kuza Moment Fund, and the like for a starter? I hope you are talking about money market fund. If it is money market fund, you can always play around with it. When share prices are up, you put money in a money market fund, because for them, they invest on short-term liquid and profitable instruments. Then when share price goes down, you withdraw your money market fund, put in shares. If it is equity funds, remember they invest in shares, both locally and internationally. So whatever affects you as an investor at NSE affects them. So the returns may be limited. So if it is an equity fund, you need to be very careful. Check where they invest. Is it on shares or fixed income or mix of both? With the market stocks already relatively high, especially banks, should investors still buy stocks now? Wait 2026 Q1. You can still buy, but not with big volumes because of dollar cost averaging. You may anticipate price may go down. Then unfortunately, banks continue doing better, prices go up. So when investing for now, don't put a lot of money in stocks that have, which are already overvalued. Wait for Q3 results. As I said, they are coming end of this month and early November. That will tell the direction the bank shares will go. Gold, I think that I'm done. Will you do session on open day and tips on how to buy raw to average your cost down? I've already done that, but happy to repeat, maybe on Wednesday. But that video is already on that YouTube channel. I can't remember the title of the video. You know, there are many. As I have said, this is the 13th episode. But you can check. There should be one that talks about your open day dollar cost averaging, all those, and the notes are also available. If you look at the video, there is a link to my blog. That's where all notes are. Right now, stock prices are generally high. Is it a good time to enter market or wait for prices to come down? I wouldn't advise you on waiting for prices to come down because it is not guaranteed with one share trading. What you can do, you can still buy, but not in big volumes. Put your money in money market fund. Then when prices go down, that time you can bring all money back. I think for Standard Bank, it's already clarified. I think I may have mixed both. Thanks, Victor and Carolina. So Standard Bank is the one that wants Stanbic. Then that merger in CBA. But I don't think this is approved by the regulator. CMA and NSE, I think they also clarified their position. No? Let's just wait for that before making any decision, no? So that you don't lose your money. With that and with the time I've gone, I think today I'm a bit on time. I'd planned it would go to 3 p.m. But at least we have done early. So I'll see if I can organize for international stock trading on Monday. Then Wednesday we finalize on NSE because there are few. If you look at what I had planned to do today, there are few things I've not covered in details. So we can do that on Wednesday. Then from there we go to our usual Wednesday, Friday, and sometime on weekends for other products. So thank you so much, and I appreciate your time for today. And also for coming on weekend. Thank you, and let's meet next time. I'll share this recording on that YouTube channel and also on the WhatsApp community and other channels that you found this announcement on. Thank you so much. Let's meet next time.